Welcome. It's a very pleasure to welcome to Florence today for the third BABEL International Conference in cooperation for the first time, and we are very, very glad here, with the European Banking Institute. I leave immediately the floor to the rectors of the University of Florence, Professor Alessandra Petrucci.
So good afternoon, and welcome again to our university. This is our Aula Magna, and it's a pleasure to host you for this important meeting, the third edition of BABEL International Conference. I'm very, very grateful of your presence. And as you know, our city, Florence, is famous also because the Medici family changed the banking system radically, supporting artistic innovation, and not far from here, in Prato, the merchant Francesco Datini invented the bill of exchange system. Therefore, here there is a genius loci that enhances this tradition that today brings you to our city to investigate a fundamental moment of transformation in the history of finance. So I have a look of the program, I'm browsing the program, and I have understood that this meeting represents a significant opportunity for discussion for young researchers who taking this first step in the academic world, and will be called upon to shape the future of research in this area. The conference brings together distinguished voices from academia, central banking, legal research, and technological innovation, which are rich and very varied program based on transdisciplinary dialogue that harmonize technological progress with prudential supervision and market efficiency with systemic stability. The reflection you are developing on digital currencies must not lose sight of human values and social benefit, because any intervention must take into account the reference context and place man at the center. Professor Zatti rightly emphasizes that Florentine humanism has been successful in this perspective, and the commitment must be aimed to maintain this approach. And so I thanks Professor Zatti also for this, for share this thinking, also to organize, obviously. And so I'm very grateful to you all for your participation and your valuable support, wishing you a pleasant stay here in our university and in our city in Florence. Thank you very much.
In life, someone is more lucky than others, and we are very lucky to be born in Florence. We have a lot of beautiful things, and we are inspired by the beauty of this town. So thank you, rectors, for reminding us the essence of our city. Thank you so much. Thank you. If you want to stay, we have now the Chancellor of the European Banking Institute, Mr. Leone, Enrico Leone.
Dear ladies and gentlemen, dear lucky friends, it's a great pleasure for me co-opening this conference this afternoon, which the European Banking Institute I represent is very happy to support. Let me extend EBI's gratitude to the Florence University for their organizational effort, Professoressa Alessandra Petrucci, and in particular, Filippo Zatti, Professor Filippo Zatti, who has been the promoter, the mind, and the engine behind this event. Professor Zatti, who I'm happy to remind, is one of the fellow members of the European Banking Institute, has kindly requested EBI to participate and collaborate for the success of this event, thinking, I imagine, that our institute was the perfect partner as our mission is fully in line with the spirit and targets of this conference. Let me spend a few words to introduce you our academic project. The European Banking Institute was founded 10 years ago with a dual purpose: to establish a coordinated structured approach to research in European banking and financial regulation, and to facilitate the meaningful dialogue between universities, regulatory bodies, and the banking and financial industry, enhancing our collective understanding and crafting effective solutions for Europe. Today, EBI proudly encompasses 36 academic members across 23 European countries, each with a specialized and recognized focus on banking and financial regulation. Under the academic leadership of Christos Kostros, EBI has achieved significant milestones. The publication of over 180 research papers within the EBI Working Paper Series, the launch of the EBI Book Series in collaboration with Belgrave Macmillan, the development of a comprehensive database of EU cases in banking and financial regulation, the weekly dissemination of the EBI regulatory report, detailing economic policy and financial regulation measures in Europe. And finally, the formation of the Associate Researchers Group and the Young Researchers Group, fostering interdisciplinary collaboration and learning. Overall, we have more than 150 experts in the field of banking and financial regulation collaborating with EBI. EBI was honored to be selected by the ESAs as one of their academic partners under the University Partnership Program. And it's our intention to have with them a long-term and intense collaboration we expect will benefit our academic members and their research output. Even if these are remarkable achievements by themselves, our project is in constant evolution and is benefiting from suggestions and ideas from our academic, institutional, and supporting members. The unique aspect of EBI is the robust support from the banking industry, both private and public institutions. I would like to acknowledge the essential contribution from our supporting institutional members who have helped EBI financially and continue to do so, allowing the development of our academic project. Here in Italy, I would like to thank the ABI, the Association of Italian Banks. Our advisory board members include senior representatives from national supervisors and European public institutions, and they have been instrumental in enriching our academic activities with their expertise. Together with the representative of the supporting members, we have the pleasure to be advised and guided by representatives of the ECB, the SRB, EBA, ESMA, ECA, BaFin, Bank of Italy, the Banco de España, the Dutch Central Bank, and the Portuguese Central Bank. This synergy is what transforms a well-crafted research into solutions with a real-world efficacy. Today's conference is an example of this approach. It aims to stimulate the debate among academia, stakeholders, and regulators, and it is focusing on very relevant topics, which are on top of the political agenda of the European institutions. Our panelists will analyze and discuss the legal and economical aspects and consequences around the reshaping of monetary landscape through digital currency and payment systems, so contributing in understanding of one of the strategic objectives of the EU, which is strictly connected with today's debate, the creation of digital euro, its implications and potentials. For example, if digital euro will be able to counter the growing dominance of US dollar-backed stablecoins and protect the Eurozone monetary sovereignty. If I may add some element to the discussion, it would be useful if the panelists and speakers could consider the position of the banking industry, in particular give their contribution and elaborate on how to preserve the intermediary role of banks, how to ensure that the digital euro is distinct from electronic payment methods, and how its introduction will develop new services or improve the existing one. Many thanks for your attention. I leave the stage, I think, to Professor Maria Elvira Mancini, Head of Department of Economic and Management, for her introductory remarks. Am I right?
Thank you.
Or am I right?
Yeah. That's how EBI works, very efficient, because you already substitute my role. Thank you, Mr. Leone. Thank you, Enrico. And now it's my pleasure to introduce the head of the Department of Economics and Management here at the University of Florence. She's a mathematician, and she is Professor Maria Elvira Mancini. Maria Elvira? Thank you. From
Filippo.
Barcelona,
Okay.
because she studies now for a visiting period there. Thank you, Mavira.
Thank you, Filippo. Can you hear me? I hope so. Thank you very much. I am sorry not being there with you in this beautiful place, our University of Florence, but I am visiting another beautiful place, the University of Barcelona. So on behalf of the Department of Economics and Management, I would like to welcome all of you to the conference. It is really an honor to host scholars, researchers, professional students from around the world gathered here to explore the challenges and opportunities offered by digitalization of money, tokenization. Tokenization represents really a revolution in the way digital assets are conceived and managed, enabling the transformation of physical financial assets into easily transferable and divisible digital tokens. This evolution can actually increase transaction efficiency, reduce cost, promote financial inclusion, and opening new perspectives for emerging economies, a more resilient financial system. But the issue of regulation and legal recognition of the digital money is really crucial. The definition of a legitimate tender must adapt to this new reality, ensuring the stability, the protection of consumers, and the compliance with the international regulation. Your conference really emphasized the importance of the dialogue among legislators, innovators, stakeholders, in order to shape a regulatory framework that can encourage the responsible adoption of digital currency and tokenization technologies. Only through careful regulation and shared understanding of the potential and the risks, we can fully harness this potential of the digital revolution, contributing to a modern, inclusive, and stable monetary system. This conference thus represents an important opportunity to share innovative ideas, discuss the economic and social implications of new technologies, and contribute to shaping a new, efficient financial future. I thank all the speakers and participants for their contribution and their interest in this highly topical subject. A special thanks also goes to the organizers, particularly Professor Filippo Zappi, for making this event possible. I know a lot of work has been done in this direction. I hope that today will be filled with stimulating discussion, sharing, and constructive exchange. I wish you productive days of insights and idea exchange. Thank you very much for being with us and for the work you will be doing during these days. Thank you, Philip.
Thank you, Professor Mancino, for the kind words, and especially for having found time to stay with us. I think it's the first time in Italy that we are short of time in the sense that short in the sense in the contrary, because we are earlier than expected. So my speech was at 3:15, but I try to introduce now. Probably we dedicate more time, not now. Now the director of production, Dr. Ferri, told me, no, I had to stop it, please. But I don't know how exactly have to say without talking to the speaker. Sorry, I think it's better because I have online Professor Mancino, so I can continue. Thank you so much. Okay, I've written some words because we have, in a way, yes, in 15 minutes more or less, is lasting my short introductory remarks, and then we have Professor, as you know from the program, Professor Chu from London. Honorable Rector of the University of Florence, Chancellor of the European Banking Institute, Head of the Department of Economics and Management, distinguished speakers and colleagues, ladies and gentlemen. The idea of hosting the conference in Florence dates back to 2023. In the autumn of that year, the research project we had presented, led by the University of Turin and Milan Bicocca, had been granted by the ministry, the Italian Ministry of the Research and University. The project, whose principal investigator is Professor Riccardo De Caria of the University of Turin, obtained funding for a project named Designing a Governance for the Tokenized Economy in a Decentralized Era. The research team comprises researchers from different scientific backgrounds, law, economics, and computer science. The research topic of the Florence unit led first to the publication of a volume, probably already met it before entering the May Hall, and this volume was co-edited with another organizer, to whom goes my very deeply thank Professor Rosa Giovanna Barresi. This book was published earlier in 2024 in the Routledge Giappichelli Studies in Law series, and then led to this conference. In the fall of that year, we are talking still about 2023, we first discussed the possibility with Professor Christos Gortzos, chair of the academic board of the European Banking Institute, who is with us today, and is going to take the floor as a chair in a few moments. We thought exploring the issues related to the evolution of money as digital and how it could affect the current financial and monetary system. We thought that was still and indeed relevant. Professor Gortzos and Mr. Leone encouraged the idea. I must thank both for their enthusiasm and vision. Thank you. Indeed, it was not so easy those days to imagine our current living scenario. In our region, meaning Europe, the markets in crypto asset regulation, MiCA, came into force on June 29, 2023. The day before, the Commission issued 2 regulation proposals, as you probably know, concerning establishing a digital euro and another on the legal tender of euro banknotes and coins. After almost 2 years, we are still waiting for the first reading procedure to be completed by the European Union Parliament. At the same time, the digital euro preparation phase, which started again in the fall, November 2023, is expected to be completed by next fall this year. In other regions of the world, many other central banks are exploring the possibility of adopting a central bank digital currency to varying degrees. However, the very few solutions adopted so far suggest that citizens are wary of using this currency instead of physical currency or even electronic money. The reasons given are varied and seem to differ mainly according to the role that the financial and banking system plays in the economy in question. This leaves room for hybrid solutions in which fiat currency is brought back into play by pegging the value of a private digital currency to that of a public currency. I think, obviously, you understand, of stable coins, referred to by the European legislator as asset reference tokens. With the advent of the Trump administration, they have become a hot topic. Tether, once considered a scam, I remember I was visiting Edinburgh University. I was the blockchain center of Cardano, and the researcher told me, Tether, you're crazy, it's a scam. Now Tether, as you know, is become a functional solution to the needs of the US dollar in the face of the challenge posed by the BRICS countries to the dollarization of the financial system. The approach of the US legislator towards the crypto world, as advocated by the Genius Act, meaning, as you know, is very interesting, the acronym GENIUS, guiding and establishing national innovation for US Stablecoins Act, has changed profoundly. And the regulation of stablecoins is presented here as an intangible intervention intended to protect consumers by requiring stablecoin issuers to maintain one-to-one reserves, prohibiting algorithmic stablecoins, and require issuers to comply with US anti-money laundering and sanctions rules. Importantly, according to the proponent of this legislation, It will empower responsible innovation, maintain US leadership in digital asset and blockchain technology, and keep crypto companies and jobs onshore. This brings the analysis back to the essential issues that currency raises from a legal, economic, and today, technological perspective. That is, to the concept of monetary sovereignty and consequently to the meaning of legal tender. The time for immediate reference to the ideas of scholars, such as von Hayek, who spoke, of the decentralization of currency is now over. The question now concerns the very origin of money and its conceptual confusion with that of a means of payment. I'm very glad, I'm very, how to say, happy that some of you clarify me what is the difference between means of payment and instrument of payment. No? I know from a legal perspective, but the functionality of money is not so simple. And you know that especially the executive board of the European Central Bank said many times that the digital euro is a means of payment. So it's just a question that I leave all the panelists to clarify me. The question now is not only that, but we need to reveal what really lies behind, yes, the chiaroscuro of the contrast between public and private money. Caravaggio's painting technique inspired us in sketching what is now a contrast that is interpreted in a dualistic way, but deserves greater attention from scholars in order to avoid falling into the trap of a priori distinctions between what is good and what is bad. Researchers, including those working in the legal, economic, and quantitative sciences, must have the courage to go further in order to confront politics with clear choices that are easily understandable to most people. After all, money carries with it constitutional requirements, both in terms of economic and financial stability, and in terms of the transmission and recognition of rights. Not only economic, but also constitutional freedoms. This is why the analysis cannot stop at abstraction or realistic visions that subsume the idea of truth within themselves. Opportunities for discussion between scholars and the market operators at the various levels are rare. Dialogue today seems unthinkable, at least at this stage. Every organized center of interests seems only to be pursuing its own economic and financial and monetary agenda. On the other hand, there are moments in the human history when it is believed that what is being done must be completely revolutionized, only to realize that the implementation of new ideas has actually led to a world worse than before. The conference will not change this adage. But if we are here in Florence, or remotely, it is to be inspired by history, and to at least try to make a reliable contribution to such a sensitive issue as currency. This is not about writing about, as many says, the future of money. Rather, it is about outlining what money is when it becomes digital, and whether it is really just an alternative payment system useful for bridging the gap between traditional payment instruments and the possibilities offered by the implementation of distributed ledger technology. Is central bank digital currency really just a means of payment? Is private digital currency primarily a tool for financial inclusion? Opportunities for discussion between scholars and market operators at various levels are rare, and we hope to give the possibility to you to do that during these 3 days. The new opportunities offer a wide range of possibilities, but they all concern the ability to control money, not only as a means of monetary governance, but also as an instrument of economic policy. I do not wish to now revive the now abandoned concept of the programmability of money, but it is clear that it could be attractive in the future to make changes that would ensure that it can be used to control even the individual choices of private individuals. At the same time, however, technology also presents us new possibilities, such as the tokenization of money produced by the banking system, as in the case of deposit tokens, creating new conditions for instance, limiting the phenomenon of bank runs. We will try to address these issues in a unified manner in the 6 sessions represented in the symbol of our conference by the 6 Medici balls, starting with today's roundtable, continuing tomorrow with 4 panels at the Novoli Social Science Campus. And then we conclude with the second final roundtable, and thanks to the Department of Law, to Villa Ruspoli. We will look at various aspects of money and the related issues, how it is being refined, redefined, the concept of digital legal tender, and its implications for monetary policy and financial stability. The challenges facing technology, and with it, supranational organization. We have with us the Bank of International Settlement, International Monetary Fund, political institutions, and monetary institutions. We have many central banks, not only from the speaker, but also between the attendees. Our goal is to bring together our daily research on these issues, to contribute with our individual experience and expertise to improving the quality of the picture that has been painted so far. I would like to thank all the speakers, both in person and remotely, for accepting our invitation. Many of you will be meeting each other for the first time. Some have traveled a long way to be here. Florence helps us in this. But I hope and believe that you have also done so because you felt that the invitation from EBI and BABEL as research units of the Department of Economics and Management of the University of Florence was not a one-spot invitation, but an invitation to those who wish to create a sort of permanent forum on this issue. One last thought before concluding. And before we are inspired in the words of Professor Iris Chu, who will be joining, as I told you, from London. Why the title of the conference? Why use Forge instead of mint for the tokenization of money? Because it recalls the greatest challenge we face. Identify what is authentic and distinguish it from what is counterfeit or artificial. After all, blockchain technology aims to help humanity with what is most difficult to guarantee, and what it has attempted to guarantee through law, trust. This can be read in Satoshi Nakamoto's white paper, and before that, it can be read in numerous works and writings on currency. I didn't mention because I know that you know I'm referring to which kind of books and papers you usually read about it. And concretely, on every $1 banknote, in God we trust. To say that the currency is what it does overlooks a precondition of currency to function, to work. Money must first and foremost function in all circumstances and must not become a tool for anyone. The idea of money as a public good, although anomalous from a purely economic point of view, hides this very necessity. The monopoly of its legal value conceals this important ambition to belong to everyone. In a financial system in which geopolitical tensions are running high, and we are stuck with a monetary system created for a very different geoeconomic context, there is a risk of forgetting that the monopoly of public money is not a privilege, but a guarantee for everyone. I wish us all good luck in our work. Thank you. And now, I have the pleasure to introduce and leave the floor to Professor Iris, or better, Iris is the name. The reason that we chosen her is not only because she's an expert, because the first name of Professor Chu is Iris. For Florence is very important, the iris. And this is the May, and May is the month of irises. I don't know if we have with us, I don't see anyone? She's? Okay, Iris, to you, thank you.
Since 2016, Professor Iris Chu has been a corporate law and financial regulation professor at UCL. As an academic member of the Center for Ethics and Law, she promotes public and stakeholder engagement on issues related to the law and regulation of the banking, financial, and fintech sectors, the crypto economy, and broader business governance.
I leave the floor. Thanks for joining us, even if from London. How was the weather in London?
Not warm at the moment. I think we are 13 to 14 degrees, so still waiting for spring.
Okay, so better in Florence, at least for the weather. Thank you, Cyrus. I leave you the floor. Thank you.
Right, thank you, everyone. My name is Iris Chu, and I hold the chair of Corporate Law and Financial Regulation at UCL. I'm very grateful to the organizers of this conference for allowing me to present this remotely. I have personal reasons for not being able to travel much, and I've therefore missed the opportunity to engage with you. But please feel free to reach out to me via my institution email on this slide. And I hope very much to continue our conversations as you might be interested in whatever I have to present. So today's keynote address, I've titled it, Would MiCA Snuff Out the Global Stablecoin? It's a slightly provocative title, and hopefully I'll take you through my analysis, which I hope you may find to be of interest. So first, let me congratulate Professors Zatti and Baresi for their excellent volume on digital assets and the law. And my address today is focused on stable coins as a type of digital assets. And the paper that I'll be basing on is my recently published work, which I'll be introducing in a second. But basically, I will critically ask if the FSB policies, that is the Financial Stability Board's recommendations for regulating stable coins, and MiCA's regulation is of a nature that enables the industry or disincentivizes the industry, or a mixture, and to extend to, what extent in each way. And in particular, I would like to draw your attention to a quote from an FCA policy officer, Enrico Rossi, who wrote in 2022 that stable coins are lumped together as a group because of its technical features, mainly because they are purported to be pegged to a fiat currency or one or more fiat currencies, and they usually have some collateral backing. However, there are actually many different users of stable coins, and the typologies of stable coins are rather varied. And it is a question whether regulation has managed to capture all of these differences and to bring about a regime that is suitable. So my address will be based on this paper. The title is Global Stablecoins Without a Future, Analyzing Europe's Regulatory Defense in the Markets for Crypto Assets Regulation as an Internationally Leading Example. So this paper is forthcoming in the International Lawyer, which is a journal published by the American Bar Association. So I've been informed that they will publish it in May. So I'm not sure if it is out yet or is going to be out, but it is hopefully very imminent. MiCA stablecoin regulation is a regime that includes all types of stablecoins. As long as there is a reference to one or more fiat currencies, that kind of stablecoin will fall within the regulatory regime of MiCA. So basically, the regulation for stable coins is built upon a framework that is targeted at a type of stable coin called the global stable coin. The global stable coin is defined as being pegged to one or more fiat currencies, usually stabilized by reserves or collateral backing, and intended for cross-border transfer or international remittance. So this definition was adopted by the Financial Stability Board in its 2019 and 2023 papers. Now, my paper argued that The regulation in MiCA, which is based on the FSB's recommendations, is based on some laudable good public interest objectives. However, the effect is that it is very likely to be highly disincentivizing for significant developments and innovations in the area of the global stablecoin business model. And I don't think we are seeing very significant projects at the moment since the demise of the DM project that Facebook/Meta was proposing a number of years ago. However, many existing stablecoins that are in circulation are much more limited in terms of their functions. They work mainly as gateways to cryptocurrency purchases, and they are only able to work on the permissionless blockchains that they are programmed for. And in other words, the way these stablecoins work are not really compatible with real mainstream kind of commercial users, payment systems, and remittance. And these stablecoins in the paper I call gateway stablecoins. The paper argues that many aspects of MiCA are either going to be over-inclusive or under-inclusive for gateway stablecoin because they are essentially designed for global stablecoins, and gateway stablecoins are not actually quite the same. So in terms of the universe of stablecoins, a very brief introduction here is that the most popular stablecoins that are in circulation today are gateway stablecoins. They usually purport to maintain a stability of value, but this stability of value is what I call relative stability, not absolute stability. Gateway stablecoins are used mainly as stores of value for cryptocurrency holders because cryptocurrency is highly volatile and many cryptocurrency holders prefer to hold stable coins because they are relatively more stable and they provide an easy conversion into cryptocurrency in order for users to then carry out transactions or activities on permissionless blockchains. And those activities and transactions on those blockchains are settled in the native currency of the blockchains, which is the cryptocurrency that is programmed for the chain. There's another type of stablecoin that some innovators have tried to develop for these permissionless blockchains, and they are called algorithmic stablecoins. They are experimental in nature, and developers try to use modeling in terms of behavioral economics and adjustments in supply and demand protocols in order to maintain relative stability of value for these algorithmic stablecoins. But they are usually not backed by reserves. And to date, many of these experiments have either not been successful or the coins are definitely not trading at par with the US dollar. Some of them are trading at a few cents, for example. So in terms of being a stable coin that's widely adopted by cryptocurrency holders, many of these projects have not been successful. And then more broadly speaking, kind of beyond the stablecoin universe, but it's a matter of definition, are tokenized financial assets, instruments, or tokenized representations of value that we may call money. And these are more broadly just digitalized versions of bearer value instruments, and some of them are designed to be transacted in web peer-to-peer type interfaces. So that is a broader conception beyond the stablecoin definition that we see adopted in the FSB or under the regulation in MiCA. But it is a continuum in terms of understanding what these digitalized representations of financial instruments or value intend to do. And they are intended to represent value, sometimes a relative stability in value, and to also mobilize exchange and liquidity. Now, one example of this sort of alternative, innovative, tokenized representation of a financial instrument would be something like Paxos Gold or Tether Gold. These are tokenized representations of value that are backed by gold. And so holders will be able to redeem these for gold, as well as hopefully use these as exchange instruments of value. Now, in essence, what is the demand or what is the innovative value of these tokenized, digitalized representations of bearer money or financial assets? Now, these are privately issued, and their innovative value lies in supporting peer-to-peer Web3 transactions. And at a level of innovation, because they are bearer in nature and they support peer-to-peer transactions, they have the potential to bypass existing account-based transfer and settlement architecture. And we could say that conventional transfer and settlement architecture usually takes a bit of time. And these real-time bearer-based transfers may increase in efficiency in terms of achieving speedier real-time delivery versus payment. So this is the kind of innovative value that we are looking at, if we allow these innovations to be mobilized and see what they can offer. So they can be rather disruptive. However, for them to be very successful, they will need to build out network effects as well as social trust. And one of the crucial issues underlying social trust is that these instruments tend to be privately issued, and privately issued instruments may suffer from market discounts in value because the market may not have full confidence in either the issuer's solvency or the financial stability. So privately issued instruments may be innovative in nature. They may meet a new type of payment and settlement need. However, there are issues considering whether or not the issuer itself can be trusted, whether they can mobilize to become collective goods for people to use them reliably. And it's these possibilities that have focused regulators' attention. So regulators' attention really is focused on the potential systemic kind of discounting or runs on these stable coins, and the risk that these privately issued tokens that purport to be money, purport to be stable in value, if they disappoint users and the network of users is significant, then we may experience systemic fallout effects if they don't function as promised. So despite the risks of this type of innovation, there has been a project that was very ambitious, raised by Meta, Facebook, called GM, which made regulators rather concerned. And that was the genesis of the stablecoin regulation designed by the Financial Stability Board and ultimately now found in MiCA. But what is curious, of course, is that this very much discussed project ultimately did not take off. And we are not actually seeing alternative projects with this sort of scale or ambition in its wake. And a crucial question is whether the regulation itself might be strangling and disincentivizing. And so the balances in regulation really have to be considered, even if some of the public interest objectives that I have alluded to briefly, are very important. So in terms of Meta's project, it was initially called Libra, and then after that renamed as GM. And Libra's project was to issue a stable coin that would be able to exchange for many different global currencies and therefore had to be backed by different fiat currencies. And users on the vast Facebook platform could then transfer these tokens to each other internationally on a peer-to-peer basis, bypassing existing account-based transfer and settlement architecture. And this would revolutionize international remittance, providing a very disruptive alternative. So the vision and the idea could be very alternative, could be very disruptive in nature, but the project ultimately ran into many problems because it is inherently challenging for an alternative architecture to be built out internationally across Meta and Meta's various international partners. And the management of reserves against many different types of fiat currencies was also very challenging. So in the end, Meta confined its project to the US dollars, and it was meant to be only domestic. However, that did not receive the regulator's blessing, and Meta sold all GM-related assets to Silvergate Bank in 2022. And I think that is a sign of acknowledging that perhaps only a player in the banking industry, or perhaps the multinational banking industry, was best placed to carry out a global stablecoin project. However, Silvergate Bank, as many of us will know, was a casualty of the American bank crisis. It was liquidated in September 2024. And so the GM project is probably as good as dead in the water. So with all of these challenges, there is a question as to whether regulation should perhaps be more enabling in nature. But the reality is that the regulation, the shape of regulation in MiCA is much more defensive in nature. And what is it defensive about? It is defensive of the monetary sovereignty of the fiat currencies, of the euro, of member states' national currencies. It is also defensive of the singleness of money, that money-denominated instruments must be able to convert at par value. And implicit within such regulation is a skepticism that the private incentives to issue a collective good for global monetary use, such as a global stablecoin, are itself very questionable. That private incentives might not be trusted to provide a collective good that is stable and that will function predictably for users. And there might be conflicts between private incentives and the needs of collective good users. And so strong regulation is therefore needed to underpin the absolute stability of value of privately issued stablecoins. However, one has to bear in mind that empirically, we observe that gateway stablecoins, for example, have lost their pegs many times. And users or gateway stablecoin holders have not been completely turned off by the market. They have accepted a kind of relative stability rather than absolute stability. You might say that this may not apply to the global stablecoin when we apply at scale to conventional payments. So there is good reason why public interest objectives to underpin the absolute stability of value is important. That said, such regulation would, however, likely create disincentives for the major players, both banks and fintech, to develop global stablecoins. So this is just a slide to explain that specialist gateway stablecoins have lost their peg several times in 2018, in 2022 for Tether, in 2023 for USDC. And these were temporary, and market confidence did recover after the initial depegging, and they remain quite highly market capitalized. So in other words, gateway stable coins are treated by the holders in a slightly different way with different expectations. And therefore, there might be a disconnect between regulators' hypothetical concerns and users' concerns where gateway stable coins are concerned. But gateway stable coins are caught within MiCA's regulation of stable coins in the same way as global stable coins. And the current landscape we have is that many gateway stable coins find MiCA to be rather ill-fitting, whereas global stablecoin projects are, well, have been very slow, if not stalled, and are very modest in nature and very conservative. And so there is a question for what regulatory policy intends, to achieve. Now, in terms of what are the disincentivizing features of regulation, I would first say a few words about why the global stablecoin is an inherently difficult business model. It is inherently difficult because privately issued tokenized money, in order to perform as a disruptive, innovative alternative, it will have to offer its own settlement and transfer architecture, which is more efficient and also secure and also reliable versus the account-based systems that we have built over the years, which is supported by the collective goods of international standardized messaging that SWIFT provides, and the central bank ultimate settlement system, in terms of banks holding their accounts to central banks and having transfers reconciled and settled that way. So a private architecture that rivals that is very difficult to build for private issuers, whether banks or fintech partnering, other international partners. And also, even if they build out an alternative architecture, tokenized money would still have to work with account-based money because users do not all convert or live on one system and not the other. So there still needs to be partnership and interoperability, which is very, very difficult. And even if all international partners are robustly regulated and they have fully backed very high levels of reserve regulation internationally will remain fragmented, because that is the case if we look at MiCA's regulation as comparing to some of the US's proposed bills and the UK's discussion papers. There are slight differences in each jurisdiction's reserve regulation for stablecoins. So if we talk about a global stablecoin needing that kind of international partnership, coordination, and convergence, is inherently already very, very difficult. And in terms of MiCA's regulation, it kind of exacerbates some of the difficulties that will be faced by a global stablecoin business model, partly because full reserve regulation, even though very attractive in public interest, creates certain disincentives. And I think both come simultaneously and concurrently. And it's a very difficult trade-off and dilemma. So I argue in the paper that for banks, reserve regulation for the issuance of global stablecoins will be very disincentivizing because reserve regulation sits on top of banks' existing capital and microprudential regulation, capital and liquidity regulation. And so reserve regulation adds an extra layer of cost. And banks would therefore prefer to intermediate deposits, such as tokenized versions of deposits and conventional payment services. It would be much more expensive for banks to develop global stable coins as part of their remittance and transfer suite of tools. Further, MiCA provides for narrower investment management possibilities in terms of the reserves backing each stable coin than for e-money issuers. And so there are relative levels of unattractiveness engaging in this as a business model, not to mention that there are certain absolute caps on issuances. And the other key disincentivizing feature for both banks and fintech in MiCA is that there is concurrent application of mandatory disclosure and merit vetting for stablecoin issuers, along with reserve regulation and prudential regulation. And this regime of mandatory disclosure for stablecoin issuers is unique to MiCA, because neither the UK proposals nor the US bills require this. And mandatory disclosure regulation presents a continuing legal risk for issuers, because if the stablecoin has any functional problems or defects in due course, and holders suffer inconvenience or loss, then they could always go back to mandatory disclosure in terms of promised benefits or functionality and mount a claim for defective disclosure. And so this leaves an open legal risk for designers and developers of stablecoins. So in other words, it's very likely that banks and fintech would find the e-money business to be much more attractive and less burdensome than the global stablecoin innovation. And for gateway stablecoins, MiCA doesn't really map onto gateway stablecoin users' needs either. Empirical research finds that gateway stablecoin holders hold them for hedging purposes against cryptocurrency. So they are much more of an investment instrument to them rather than money or for payment. And it is queried whether these particular more limited, narrower functions could actually be treated in a different way for the purposes of regulation, so that gateway stablecoin issuers and the industry would not find MiCA to be so disincentivizing to them. Before I return to this slide, I would just say that the current developments for gateway stablecoins is that many of the large popular gateway stablecoins that are in existence for cryptocurrency holders are shunning the EU market as a result of citing difficulties with complying with MiCA. So Tether, for example, is phasing out its EuroPEC token. And there is an on-chain stablecoin developed by a decentralized autonomous organization called MakerDAO. That stablecoin, previously called DAI, which has now changed its name to USDS, is also no longer accessible to residents in Europe. And the DAI token is being replaced so that the new token would not face compliance issues with MiCA. And Binance will also see support for the BUSD, which is its own stablecoin, citing difficulties again with MiCA. So the most popular stablecoin that has currently continued to function and is able to be offered to European residents is the Euro version of the USDC, which has been approved by the French regulator and is issued by Circle, which is a US-based firm. So I'm not saying that just because industry shuns MiCA, MiCA will certainly have to, turn over backwards in order to adjust itself to them. But it is a moment for reflection. And in terms of regulatory design, there is a question whether some of the more limited characteristics of gateway stablecoins can be regulated differently. For example, through more mandatory disclosure in terms of their characteristics and their functions and their promises to users, as well as thinking about whether governance-based regulation, incorporating more user empowerment into the governance of how these gateway stablecoins are being issued and used, whether users should be more involved in some of the policies, which is showcased in the example of MakerDAO's governance of the stablecoin USDS. So these are some examples of alternative forms of regulatory design that might be more flexible, that might not constrain stablecoin issuers to very prescriptive forms of regulation. And bearing in mind that because users desire relative and not absolute stability, there is a question of whether we really need to have such conservative forms of reserve regulation. And it could be that regulation for stable coins can be designed more in accordance with typology or on a sliding scale, so that where gateway stable coins may morph into something more conventional or offered to the mainstream, then the public interest concerns regarding payment and absolute stability in value may then bite, introducing the opportunity to be subject to forms of regulation that are more consistent with payment services and instruments, that purport to represent monetary claims. So it could be something to think about in terms of building in more flexibility and more sensitivity to industry needs. And so finally, in conclusion, often regulation can enable and make markets, as we have seen in the example of PSD2. However, I think MiCA's position on global stablecoins, disincentivize that innovation as well as turn away many of the other gateway stablecoin innovations from this market. And although we might say that the central bank digital currency is a much better alternative to privately issued global stablecoins, probably this defense is a good thing. We might weed the global stablecoin out altogether. But yet we have to think about what we might lose in terms of innovation. And CBDCs will always be fragmented along different jurisdiction lines, whereas global stablecoins can potentially bring about some sort of privately fostered convergence. So this presentation is not about just critically taking apart MiCA's regulation for global stablecoins, but really posing some questions about the balances that we can further think about in relation to industry needs, in relation to the sort of innovation that we want to keep an open mind to, and being able to reflect on critical shortcomings that might disincentivize industry from moving further and might have innovation stifling effects. So thank you very much, Professor Zatti and Barassi, for inviting me to give this presentation. I think I might have gone a little bit over time, but back to you, and I'll stop sharing my screen.
Iris, great. Also, you are in time perfectly. It's very strange in Italy. We are perfectly in time because it's 4 o'clock. So, a lot of questions. Thank you, Iris. I was hearing among some troubles that we have in the technical team, and I was wondering, you thought of a global stable coin. Why do you think the need to have a global stable coin? I mean, obviously, stable coin, for the reason why it was thought, is naturally global. But I mean, you also can think about regional stablecoin. Why a global stablecoin? What do you think about?
Right. The global stablecoin is the definition that the FSB adopted. For any stablecoin that has cross-jurisdictional transfer possibilities, they call it global. But I perfectly agree with you that it can be regional, but it's still cross-border. And when you have something that's regional, that has the capability of being cross-border, there is no stopping how far cross-border it can grow and it can go. So I think the global stablecoin is not a bad description of something that is not purely domestic. I think if you think about it that way. And in terms of what use there is, I mean, I know that an often offered critique is that because money is a public good and the central bank's provision of money has been the most stable, development over the last decades, centuries, And so why is there a need for privately issued money? I think the only thing I can say about this is that we cannot completely foretell how this will be used. I think the only thing we have to maintain is a very open mind for innovation. And I can see that peer-to-peer type transactions could very well run on this sort of privately issued money. And peer-to-peer transactions may very well also be faster, although we could say permissionless blockchains are not faster than RTGS, for example, and that I acknowledge. But I think that if you foreclose this area of innovation, if you say there is no point thinking about privately issued monetary claims, for example, and money just has to be a public good, the unit of count, the medium of exchange, the store of value are all public goods. There is no point thinking about the privately issued global stable coin. I would then say we don't know what use cases it can be put to and how our minds can be open. So I think that's all I'll say in defense, because I'm not a business model, a developer. But I would like to see what the industry can do with it, and whether we as society would see these as being, able to offer us social utility or not. And I think ultimately, if we believe in social democracy, then we as society should be given a chance, to either buy in or vote with our feet.
Okay, thank you so much. I was very impressed about your keynote address, but there was no doubt in me, and this is the reason why we ask you to take the keynote address. I hope to meet you in Florence soon and to have the possibility to travel. And thank you so much. Another warm hug from Florence. Thank you, Iris.
Thank you very much.
Professor Christos Skortsos is a distinguished financial, banking, and capital markets law scholar at the National and Kapodistrian University of Athens. He serves as chair of the EBI Academic Board and focuses on the legal framework for banking supervision and monetary policy about digital currencies. Professor Caroline Kleiner specializes in international private law and its application to financial markets at Paris Cité University. Her research explores the legal frameworks necessary for cross-border digital currency transactions. Professor Rosa Maria Lastra is an internationally recognized expert in international financial and monetary law at Queen Mary University of London. Her research focuses on central bank digital currencies and their implications for monetary sovereignty and financial stability. Dr. Franklin Knoll is a monetary historian and researcher with the Federal Reserve Bank of Kansas City. His work examines the historical evolution of money and payment systems, providing valuable context for understanding current digital currency developments. Professor Sebastian Omlor specializes in German civil law and private commercial law across German and European contexts, focusing on banking and capital market regulation. His research at the University of Marburg examines the intersection of traditional legal frameworks and emerging technological challenges in digital currencies. Professor Ruth Plato-Shinar specializes in banking law and regulation at Netanya Academic College. Her research examines the legal frameworks for digital currencies and their implications for consumer protection and financial stability. Professor Rolf H. Weber is a renowned international business law and internet law expert at the University of Zurich. His research examines the legal challenges of digital finance and the regulatory frameworks necessary for digital currencies to function globally. Professor Dirk Zetsche specializes in financial law and regulation at the University of Luxembourg. His research focuses on the regulatory approaches to financial technology and digital currencies, emphasizing European frameworks.
So the musical is over, eh? Okay. Good evening, ladies and gentlemen. Thank you very much for joining us in this evening session. Thank you, Filippo, for all your kind words. And it has been a pleasure that we have cooperated through the European Banking Institute for this conference, which nevertheless is your child. Come on. We all have contributed a lot, but you have been behind that together with yourselves. So thank you again for having made this event taking place. I feel very strange. I'm chairing a panel in which nobody's next to me. As you can see, and by the way, it's a panel of 7 persons, yeah? This is a primer for me, but again, I can live with that. The second is with a kind of bitterness. When you are chairing a panel with so many distinguished people, and some of them very good friends, you love to have the opportunity to introduce them, yeah? So you have already done that, and you have taken this pleasure out of me. In any case, we have a very interesting panel. And the panel is, or a round table, if you wish, yeah? Because we are going to, I think, set the scene on the topics that will follow in the days to come. Apparently, we will pose more questions than the answers that will be provided. I very much hope that at the end of this panel, we will, to a certain extent, disagree or agree that we disagree on certain points because they are settled. But jokes aside, I think it's an excellent panel to discuss several topics which are of relevance for our general topic being discussed these 3 days. In close cooperation with my dear friends and colleagues, we have decided, based on their expertise and what they would wish to develop, that we will split our panel in 2 parts. And by coincidence, the first part contains 4 speakers who could not make it to be here today. We didn't plan that. It happened. For some reason, some people could not make it, even last minute, like Ruth. But still, their presence online will be valuable, like the excellent presentation by Iris some minutes ago. So the first 4 speakers will speak mainly on various aspects of central bank digital currencies, history, developments, public law dimensions, international private law dimensions, and one case study, the Israeli central bank digital currency, which is in the making. And then the second panel with my dear friends who correctly are sitting there in order to be able to see the others. I will join you in a minute, by the way, down there. We'll focus on some cross-sectoral issues. Yeah, for example, what is the link finally between a stablecoin and the central bank digital currency? what is the MiCAR dealing with, and how do the central bank digital currencies fit into that, and the relationship with tokens through the banking sector? I have kindly asked my dear friends to confine their presentation to a maximum of 12 minutes because I wish that we have a first round of discussions, and then there will be a second round of questions by yourselves, among yourselves. Yeah, I may wish to intervene, asking one or two questions, and then the floor will be open to you. And I hope that after 2 hours, you will have enjoyed a very, very distinguished panel. I will give the floor immediately to yourselves, Franklin Knoll. Yeah, I cannot introduce you again, so you have the floor without further introduction. Thank you very much, and enjoy this panel.
All right. Well, again, thanks to the organizers for making all this virtual so that the rest of us in the world can participate in it. And I just need to state my disclaimer that these are my opinions and not necessarily those of the Federal Reserve Bank of Kansas or the Federal Reserve System. So here we are. Technical difficulties, I'm sorry. Here we go. All right. So we're at this conference and this roundtable to address some big questions about the future of money, society, and law. For me, the most difficult problem is getting to the basics or the fundamentals. In my opinion, if we can get to the heart of the matter, we may have an easier time finding answers. At the basis of this conference and roundtable is the question suggested by the conference title. And I believe that we are asking the question, will a new kind of money reshape legal tender? To this question, I think we need to approach it from a socio-historical perspective and following the goal of this roundtable, redefine money. If we do this, we find that the question is all about relationships. Specifically, will a new kind of money create new socioeconomic relationships that exist outside of legal tender rules? If so, how will the state respond? So let's start our analysis by looking at the definition of money. A socio-historical definition might be money is a socioeconomic technology that uses representations of value to communicate obligations or socioeconomic relationships. Let's break this down a bit. Socially, the purpose of money is to communicate an obligation between two parties. This is done by moving a distinct money object or representation of that object from one location to another, including ledger to ledger, such as between two people or two businesses. Historically, the basis of money is a distinct money object. The nature of this object is determined socially and involves cultural, economic, and technological factors. The object tends to be a portable commodity that is fungible and relatively abundant, such as pieces of metal, bushels of grain, pounds of salt, cigarettes, etc. Historically, the value of money is connected to the distinct money object and is determined socially. The value of the distinct money object is determined by the community using it, which may consider the object as being of utilitarian and/or aesthetic value. Its value may also be defined in relation to another object. Utilitarian like iron or cows, aesthetic like gold, which is also valued in relation to silver. In all cases, the determined value tends to be stable over time. Historically, the form of money is the representation of the distinct money object and its attendant value in a physical or electronic manner. This representation reflects the monetary technology of the time, be it clay tablets, metal coins, paper banknotes, or electronic ledger entries. This is what we usually refer to as money and what economists talk about. Today, money is a little different. Our current fiat money replaces the basis of money, the distinct money object with law. Now, value is not determined by the community, but by the state. How this came to be tied up with the concept of legal tender is to which we now turn. A simplified definition of legal tender may be that it is the official declaration of what is and is not money, especially in terms of what money will be accepted and used by the state. The declaration may compel, or at least impel, the usage of only that money throughout society. A new definition might be legal tender is a declaration by the state of which representation of value can be validly and thus legally used to communicate obligations or socioeconomic relationships in its society. In effect, legal tender is a form of social discipline where all socioeconomic relationships ultimately end with the state. Obligations can only be expressed through state-sanctioned means and in values determined by the state. It is the monopolization of money. But it was not always this way. In America, at least, legal tender was originally just a way of doing government business in a society filled with multiple monies. This was the case in 1830s America. At this time, there were multiple simultaneous legal tenders throughout the country, such as US government coin and Spanish silver. The government did this to conduct daily business. It needed a currency or currencies that would allow it to collect taxes and duties and pay out salaries and meet expenses within the areas it operated. Thus, on the southern coast, Spanish silver would be the current money and thus the legal tender, while in the Northeast, US government coin could be the money of preference. In other words, the state privileged at least one form of socioeconomic relationship over another, declaring it an official one, a legal one, an official money. In some, it codified this socioeconomic relationship as legal tender. In 1862, the US created its first fiat currency, the greenback. A fiat currency is by definition a legal tender, as indicated in the name of the law that created it, the Legal Tender Act. A fiat money replaces the basis of money, the distinct money object, with law. Now, value is determined not by the community, but by the state. It resulted in a new form of social discipline, a monopoly on money, a declaration that only one form of socioeconomic relationship, money, is valid before the law. All such relationships now ended with the state. Now, any obligation was communicated with official government money, and the state declared the value of it. This is where we are now. So in 2025, what is money? Money is legal tender. It is still a socioeconomic technology that uses representations of value to communicate obligations or socioeconomic relationships, but the foundations and rules of that technology, basis, value, and form, are dictated by the state, which declares through the idea of legal tender that it has a monopoly on what money is, and by extension, how citizens communicate obligations and manage their socioeconomic relationships. Here we return to the question of the conference. Will a new kind of money reshape legal tender? As currently money is the same as legal tender, the logical answer is yes. Here we come to tokenized money. And the question, is tokenized money actually a new kind of money? The answer is no if it is just a new form of money, a new representation of existing money that operates in the sphere of legal tender, maintaining the state's monopoly on money and the socioeconomic relationships that it polices. The answer is yes if it is a new money, a technology that uses new representations of value to communicate obligations or socioeconomic relationships in a new way. Such a money operates outside the sphere of legal tender and the state's money monopoly, creating novel socioeconomic relationships. In my opinion, tokenized money is both old money and new money. If we are talking about tokenized commercial bank or central bank money, we are really talking about representations of old legal tender money. Deposit tokens tokenized deposits, and CBDCs all follow the old rules of legal tender and represent existing fiat currencies. Socioeconomic relationships follow these old rules and ultimately end with the state. But if we are talking about cryptocurrencies like Zcash, Monero, and other things which barely qualify as money given their instability of value, or stablecoins, those pegged to a fiat currency, we are talking about something new. These monies generate socioeconomic relationships outside the state sphere of influence, both socially and geographically. Working outside the monetary monopoly of the state, these new kinds of money do not follow the strictures of legal tender. In fact, stablecoins seem to subvert legal tender. They take a legally defined value and appropriate it for a new socioeconomic relationship that denies legal tender and the value it declares. So, in conclusion, we return one final time to the question at hand, the one asked by this conference and this panel. Will a new kind of money reshape legal tender? And as we have seen, it's all about socioeconomic relationships. The answer is yes, if the state wishes to maintain its monopoly on money and the oversight of the functioning of the socioeconomic relationships within the state. To do so, it will have to redefine legal tender to encompass this new money. And indeed, these fears of losing control of money are not new. The rise of cryptocurrencies and the potential loss of the legal tender monopoly spurred the first interest in central bank digital currencies by central banks in the 2010s. So, and it is to these subjects that we now turn to in this roundtable, and my colleagues will, I'm sure, go deeply into this. So thank you for your attention, and I look forward to hearing our other speakers and our discussion. Thanks.
Thank you very much, dear Franklin, and in addition for respecting the time restraints. This is mostly appreciated. I have kept some notes here that we wish to discuss, but before we do that, let me give the floor to my dear friend Rosa Maria Lastra.
I was just saying thank you to you, Christos, as well as thank you to Filippo Sati, the masterminder of this conference, and the University of Florence. This BABEL, which stands for Blockchain and Artificial Intelligence for Business, Economics and Law, but it has also this other distinct meaning anchored in the Old Testament, or where we could all, no longer understand each other because we were in the Babel Tower. And sometimes in this language of CBDCs, we're a little bit in a Babel Tower. My presentation will focus on some of the public policy, public law considerations, which are important in this discussion about redefining money. So money is defined by and subject to a legal framework. Money has also social and historical connotations, and money has for very different meanings. But I put it to you that to understand money, one needs to understand it from the perspective of the law. And this law is both private law and public and regulatory law. Public law frames money and the monetary systems nationally and internationally, and it focuses on the issues and regulation of money by the state, eventually by other entities, international organizations, and also the management of money via the functions which are typically assigned to the central bank. So under the public law sphere, there has been a traditional mingling between the law of money and the law of central bank. Private law, on the other hand, focuses on the notion of payment, the function of money as a means of payment, and the protection of the private rights of contracting parties and the discharge of monetary obligations. Monetary systems comprising these institutions, the currencies, so the money that we have today as fiat money with legal tender, like Franklin was reminding us, and the norms that govern those institutions and payment systems have been traditionally linked. So there is not like a dissociation between public and private law. public and private law work together when it comes to the understanding of money and the monetary system. Commercial banks have acted as an integral part in that link between the monetary system and the payment system, given their role in the creation and circulation of money and as payment intermediaries. And indeed, in our two-tier monetary system, with central bank at the top of the monetary pyramid and commercial bank at the bottom of such pyramid, the stability of money so far has been linked to the hierarchy of central bank money, in which it sits at the apex. To some extent, one can say that commercial banks have enjoyed an exorbitant privilege. The word exorbitant privilege is usually reserved in the international arena to the role of the US dollar as the de facto global currency. I'm using here the word exorbitant privilege to define the role that commercial banks have in the monetary system. Under public law, money and sovereignty must be analyzed in parallel. And this is my first inroad into technology. If money and sovereignty must be analyzed in parallel when one talks about the public law and public legal aspects of money, the same holds for technology, and any technological innovation in public money needs to be linked to the analysis of sovereignty and the power of the state. So the state has had a fundamental role in the regulation of money and in the ordering of the monetary and payment systems. As payments are changing and as money is changing, with shadow money and shadow payments, the borders of this traditional monetary system are becoming more porous, since the institutions which have been associated with money, the central banks and the commercial banks, are increasingly being subject to competition from digital sources. Digitization of money is therefore a new chapter, though not fully crystallized yet in this evolutionary tale. Under the genus of digital currencies, there has been a traditional quartet. The quartet keeps on expanding as all technology, as all innovation of CBDCs as public options, and then stable coins and backed cryptocurrencies and tokenized deposits. I am aware that the possibilities keep on increasing. The extent to which money is thin, res in Latin, or a credit relationship or both, is linked to the evolution of money and is also linked to the design options for digital money. For instance, the design options for CBDCs, token-based or account-based, echo, they're not equal. To some extent, the design of central bank notes and coins with a physical or material existence, in the case of paper money, deprived of intrinsic value, as Franklin reminded us, fiat money because of the power of the state, and commercial bank money, which is based on credit-debit relationships and therefore account-based, with a dematerialized existence these days. In a way, dematerialization predates digitalization. Some new forms of money are data, and this raises significant issues, not only about the legal characterization of such data, but this link, which I put it to you, between technology and sovereignty, in the same way as we have had a link between money and sovereignty. The legal frameworks of money, payments, and central banks around the world were drafted before the digital revolution. Central bank laws therefore speak about coins, banknotes, and reserves, but they do not speak about digital currencies, tokens, or ledger systems. I have developed in some of my research, together with others like Jason Allen, the notion of moneyness, drawing on the functions of money, as a useful parameter to assess which objects satisfy such functions and to understand the spectrum of instruments that qualify as money or near money or quasi-money or shadow money. The money issued by the state is fiat currency with legal standards to circulate within its jurisdiction. Again, this is something that Franklin just reminded us. And it is the state that gives value to its currency through a number of norms, institutions, and policies that the state adopts to protect the internal and external value of such currency and the stability of the banking and financial system, which it protects via regulation in our current dual-tier system. Underlying such norms and institutions is the full faith and credit of the government, as my colleague Saúl Omarova likes to emphasize. And this is reflected in the law and the public ordering of the monetary system. Fiat currency, by definition, implies a degree of faith in the state, since this government-issued currency is not backed by a physical commodity such as gold or silver. A tautological definition, money is money, may help us understand what money is not. Fiat money is actually not redeemable into any other asset. It is only a claim on further fiat money. This may cast some light on the design of CBDCs going forward. As Franklin reminded us, legal tender has been defined as the power to validly and definitely extinguish monetary obligations, which must be accepted by the state as well as private individuals as final settlement. Every US dollar note says this dollar is legal tender for the settlement of debts, public and private. But the understanding of legal tender is changing, with changes in the use or disuse of cash notes and coins, and with the adoption, for instance, in El Salvador, of what is a cryptocurrency like Bitcoin as legal tender. The government has the monopoly over the issue of currency. This is a fundamental public law principle. It should not necessarily be like this. Competition in currency is not new. Hayek advocated the competition of currency a very long time ago. But the fact that the government has the monopoly over the issue of currency does not mean that the government has the monopoly over other assets that individuals might hold or wish to hold in future instead of the fiat money. And this is contributing to the blurring of the definition of money and to a de facto erosion of monetary sovereignty. Commercial banks, again, I like to go back to them because they have this exorbitant privilege in our existing monetary system, have had this key role in the process of money creation, since current accounts demand deposits or use as a means of payment. And that's why the law regulates the role of private in the creation of money. So with competition in the provision of money by non-bank and non-central bank providers, the ecosystem of money and payment changing.
Dear Rosa, may I kindly ask you to sum up in 2 minutes? Thank you.
Yes, I am actually coming up to 2 minutes.
Thank you.
Bank deposits have been trusted because they are convertible into currency and because of the belief that they are protected by the full faith and credit of the government. But as we move into understanding of central bank digital currencies as the version of digital money, which is subject or will be subject to the public law and public policy considerations to which the current central bank money has been subject so far, the question is, what will be the public ordering of the monetary and payment system in this new world? We may be talking about a future that does not exist. After all, in the UK, there was a report of the House of Lords that said, are CBDCs a solution in search of a problem? And as we know, in the United States, the executive order of the 23rd of January on strengthening American leadership in digital financial technology, it's precisely for the time being a prohibition of CBDCs within American territory. Are we then talking about only private alternatives to digital money, at least in some jurisdictions, and therefore what will be the public ordering in the same way as the state does the public ordering of commercial banks? Stable coins, and others will be talking in this conference about the role of stable coins and the relationship with CBDCs, gravitate around fiat currencies and safe assets. And incidentally, when talking about the stablecoins, the words that Humpty Dumpty told Alice in Wonderland resonate again. When I use a word, it means just what I choose it to mean, neither more nor less. What do we mean by stablecoins in the context of public law and public money? My last sentence, and I have summarized because I know that you have given me 2 minutes, that only public money ensures trust and stability. Thank you.
Thank you so much. There are so many aspects that you have raised. It's a pleasure to listen to you every time, but we all have to constrain ourselves, and apologies for this intervention. Caroline, may I give you the floor now for 10 to 12 minutes? And welcome to our group.
Well, thank you very much to Filippo Zatti and to Rosa Giovanna Barisi for the kind of invitation. And I will, of course, try to respect the time limit that our president have given us. So today I would like to speak about a subject that is a bit on the side of what has been previously said, which are the private international law aspects of central bank digital currencies. Since this is not a topic that is necessarily a topic where lawyers, even monetary law lawyers, are very versed to private international law, I thought that that would be easier to have some slides, which of course are an oversimplification of the problems I will be talking about. But please, before starting to have this short presentation, I would like to briefly mention, if you allow me, to commemorate Michel Aglietta, who is a French economist, but who sadly passed away 2 weeks ago. I would like to mention him because he has been a very great author and has contributed very much to the analysis and to the understanding of what money is in a society. So this is the title of his last book. I don't think it has been translated, Le futur de la monnaie, but I think that everyone can understand the title. And one quote that he uses in the introduction, he refers to the German philosopher George Simmel in his book Philosophie des Geldes, where it says that this is in money that the modern spirit finds its most perfect expression. And I think that could illustrate well the topic that we are dealing with today. So now going to very briefly, and again, oversimplifying it, the private international law aspect and the question of the applicable law to the holding, to the transfer of currency, to whatever operations can be done on a currency, I would like to show you a kind of galaxy of all the possible applicable laws that will come into play when currency is as an object of an operation. So when in a relationship between the issuer of the currency and the holder of that currency, there is, of course, this concept that we call lex monetae, using this Latin expression. So the law of the issuing state, a principle of public international law that has been recognized by international decisions as well as national courts. Then, if we mention another relationship, which will be the relationship between the holder of the currency and the intermediary, which is, as Rosa explained earlier, the commercial bank, to put it simply, there will be probably in this relationship a specific law that will be applicable, which is the law of the bank. Usually it will be the law that is chosen to govern the relationship between the intermediary and the holder of the currency. But if things go not so well, if the intermediary goes into an insolvency proceedings, then there might be some issues which will be governed not by the law of the bank, but maybe by the lex concursus, which will be the law applicable to the insolvency. Now, if the holder of the currency is also a debtor of a monetary obligation and has to pay to a creditor and so use his currency to discharge its obligation, then a certain aspect of this operation will be, of course, governed by the lex contractus, the law applicable to the contract. But when we speak about payment, because this is this kind of operation that I'm mentioning here, there is also another legal system that might come into play, which is the law of the state where the payment is made, which is usually called in private international law the lex loci solutionis. And finally, I would like to add another layer or another another circle here to complicate it a bit further. If currency is the object of a security, then another legal system again might intervene and might govern the relationship, which could be not necessarily, but which could be the lex reicite, so the law of where the thing is located. So you see that this galaxy is shows that when we speak about monetary relationships, different legal systems might intervene and might govern the relationship. Of course, they are not. They have different design, meaning that normally each legal system should govern specific aspects and not all the aspects. But sometimes there are some overlaps between those legal systems. Very briefly, I would like to mention some conflict of law rules that exist. There are not so many, but some countries have developed some conflict of law rules concerning the use of money. And the better example for that is the Swiss Private International Law Act, which Article 147 is quite famous, as it is a very unique provision in comparative private international law. And as you can see in the 3 paragraphs, there is a mention of one of these different legal systems that I earlier showed on the scheme. The first one being the reference to the lex monetae, then to the lex causae or lex contractus, and then the final one to the lex loci solutionis, so the law of the place of the payment. There are also other provisions, but they are less detailed and less complete in a way, which is a provision in the Romanian Civil Code, which is a quite more recent instrument. And I also put on the slide Article 38 of the Polish Private International Law Act, which is even more recent than the Romanian one. So they try to add something on the law applicable to the monetary obligation, but a very specific provision. And then on the more universal level, I would like to mention the Ancetral Model Law on International Credit Transfers of 1992, which proposes, but more as a footnote, a possible article which is a conflict of law rule, and which is just here on the slide. So this is just to show that there are few conflict of law rules that are written in a piece of legislation, and otherwise in the other countries, it is case law, or they try to apply by analogy other kind of conflict of law rules. So now the question I think that should be asked, and that every legislator and central bank thinking about CBDCs, what they should be thinking of, is not only, of course, the design of the CBDC, but how there will be a cross-border use of this CBDC, and what will be the new challenges that come from this cross-border use. Those challenges challenges will, of course, depend on the technical aspects decided by the central banks. So whether the CBDC is held through an account or whether it is more a token-based CBDC, whether there is an intermediary or not, whether a payment offline or online is possible, and also, of course, whether there is be the use of a DLT. So all these new challenges from a technical point of view, of course, have their challenges on the legal point of view, on the legal perspective, and more specifically in private international law, because all those questions then put into question whether the lex loci solutionis still has a say in the governance of monetary obligation. Then there is also this issue of data transfer that is very, very present in the European minds with the project of the digital euro. So here, another question should be answered, which is which law will be applicable to the data transfer. And the same goes for the anti-money laundering or financing of the terrorism. Which rules of AML-FT will be applied to the use of CBDC? So new challenges, new questions in private international law. So
Caroline, I'm sorry,
Yeah?
you only have 1 minute, please, to complete.
Yeah, I have 10
Thank
minutes.
you.
This is just the last slide. Just to ask you and to put the questions, because you said that we would ask more questions than answer, and to draw the new galaxy. We still have some applicable laws that will be the same than previous, whether it's like currency, whatever form it is, or whether it is a CBDC. But in the article I wrote in the book that is also at the center of this conference, is that, in my opinion, and so I will put that quite quickly, the issue of CBDC will have the consequence of having a broader, really much broader scope of the lex monetae, and also new questions concerning the applicable law to data transfer or AML-FT. And so as a word of conclusion, that's the last slide, I would like to mention that the Hague Conference is now tackling this problem, not only addressing the question of applicable law, but also jurisdiction and, which is a very important one, also cooperation in the issuance of central bank digital currency. Thank you very much for your attention.
Thank you so much, Caroline. One question for an answer later on, yeah? You mentioned that the lex monetae is the law of the issuing state. And what if the issuer is a central bank which is not backed by a state? I mean, the ECB or the national central banks. So what is the lex monetae in the case of the euro or tomorrow the digital euro? Would that be the law of Germany, where the ECB is based, which I think would be the answer, or the law of Greece, because the Bank of Greece would also issue banknotes? But this is for later on. Hello, Ruth. We trust you are well and safe, and thank you for joining, despite you had to cancel at the last moment and you are remote. Allow me to remind you before I stop you that you have 12 minutes.
Yes, thank you very much, Christos, and thank you, Professor Filippo Zatti and Rosa Baresi for the invitation. I will share my slide. Okay. Can you see and hear me? Yes,
we can
Christos?
hear you, we can see you, but not your slides.
Oh.
Yeah. Now we can see your slides, but not you.
But not me.
Yeah, everything is okay, thank you. Put your slides again, please. Here we are, thanks.
No, but can't you see like this now?
Yes.
Is okay? Okay, so starting now the 12 minutes. Okay. I would like to present research that I led in collaboration with the Bank of Israel regarding the willingness of the public, in our case, the Israeli public, to adopt a digital shekel. As you know, more than 130 countries are currently exploring or piloting CBDCs. However, there is no point in issuing the currency without a sufficient level of adoption. Hence, the importance of such research that examines the public attitudes towards a CBDC. So, our research had three goals. First, to assess the willingness of the Israeli public to use a digital shekel. Secondly, to examine which characteristics of the currency may increase the level of adoption. And third, to explore the impact of demographic and personal characteristics on the level of interest. In terms of methodology, we conducted an online survey with approximately 1,100 respondents, representing a random representative sample of the Israeli population aged 18 to 70. The survey was carried out in 3 stages. First, we had a pilot survey to test how the concept of digital shekel could or should be introduced to participants and ensure their understanding. Don't forget that not everyone is familiar with the concept of CBDC, and indeed some of our respondents, about a third, had never heard of it before. Then we moved to a first questionnaire to collect demographic and personal characteristics, and then a second questionnaire to examine preferences regarding the digital shekel features. Here you can see the description or explanation that we gave to the participants in the pilot stage. Because I only have 12 minutes, I want to go over it with you. However, the pilot was successful and we were satisfied that the participants did understand the concept, what digital shekel is. And then we moved to the first questionnaire. We started straightforward with the question, to what extent would you be interested in using the digital shekel? On a scale of 1 to 10, the average score was 6.09. So whoever gave a higher score was classified as expressing high interest in the digital shekel. And you can see here the light blue bar with 51.5% of respondents showing high interest in the digital shekel, which suggested high willingness to adopt it. As to socio-demographic factors, we found higher interest among men than women, 57 versus 46%. Interest increased with age, particularly in the age groups of 40 plus. As to income level, interest increased according to income level, and this actually correlated with age-related findings because we assume that older people earn more money. And about education, higher interest was found among non-graduates than graduates. Speaking about financial literacy and digital financial literacy, the higher the literacy, the higher the level of interest. And we also checked cryptocurrency holding and found higher interest among people who were currently or in the past holding cryptocurrency. Another part of the research focused on cash. And we wanted to examine possible reasons why people are interested or wish to hold or use cash. We examined 3 reasons. First, because of privacy concerns here. Second, maybe because of distrust in commercial banks. And third, because of the immediacy and finality of cash payments. We assumed that if these features were important to respondents in respect of cash, they would also be important in respect of CBDC, digital shekel. However, our hypothesis was rejected. None of these reasons were correlated with high level of interest in the digital shekel. Speaking about trust, we also examined trust in institutions in general and in the central bank in particular. And we found that about 70% expressed trust in the Bank of Israel, which is relatively high, especially compared to only 54.5% trust in commercial banks. And we also found that interest level in digital shekel correlated with trust in financial systems in general and in the Bank of Israel in particular. So this was the first questionnaire, and now we move to the second questionnaire and focus specifically about features of the digital shekel. We started with two open-ended questions, and we asked the participants to list advantages and disadvantages of the digital shekel, as many as they could. Here you can see the advantages that were mentioned. The three bottom lines, the most important advantages, deal with usability or convenience of use. You can see here the answers: quick, available, accessible, don't need to carry cash. So this was the most important feature. In contrast, backing by the Bank of Israel received only 10.7%, security, safety here, only 9.7%, and privacy and anonymity, only 6.7%. These attributes were far less important to our respondents. Now we move to the disadvantages of the digital shekel, and here the picture was a bit different because you can see here the common concern was related to safety and security. People mentioned cyber attacks, hacking, theft, not safe, etc. Here again, monitoring by the state received only 9.5%, and again, privacy concerns only 3% here. Lack of anonymity doesn't protect privacy. So these were ranked much lower. After the two open-ended questions, we gave the respondents a closed list of possible features of the digital shekel, including advanced functionalities such as smart contracts and offline usage. And here we asked them to mark the three most important features in their view. And you can see that the most important feature here, almost half of the respondents, protection against fraud and errors in the system, followed by the possibility of receiving interest, 3.5% interest. Protection against fraud and system errors was much lower, and only 22% here about privacy vis-a-vis the state. The Bank of Israel will not know how much money you have or where you spend it, received only 22%. And finally, we had a conjoint analysis. A conjoint analysis is an innovative statistical method used in economics and decision-making research. It allows to break down a product into its components and evaluate the weight of each component separately. So how did we use it? We showed the participants various scenarios of digital shekel, each with a different set of features. Some features were identical across all scenarios, but other features which were under our investigation varied across scenarios. The varied features were protection against fraud and system errors, either free or for a fee, the maximum holding amount, either 10 or 50,000 shekel, and again, interest on the balance, either 3.5% or no interest. And the features that contributed most to willingness to adopt digital shekel were earning interest and free protection, especially against fraud. So in summary, if we take in account all parts of our research, the preferred features of a digital shekel are usability, protection against fraud, especially if free, and earning interest, while privacy was less important among the Israeli public. So I'll stop here and be happy to answer questions later. Thank you very much.
Thank you so much, Ruth. I'm a little bit confused by some of the answers, as many of you may be as well. And that's not a problem for your research. Eventually, it's a question of literacy. Yeah? But we may come back to this. Thank you very much. It was quite interesting, yeah, to have this type of analysis in our discussion, yeah, because at the end of the day, central bank digital currency or any form of money needs to be accepted by the public, and the question is why it would not. Would you join me now in my here, dear friends? Thank you so much.
Thank you very much, Christos. And of course, first of all, I would like to thank Filippo and Rosa for the invitation to this impressive conference. Your quite short question whether there is a relation merits a short answer. Yes, but I would like to go back a little bit more into the history, because when I read the title of this roundtable, Redefining Money, I was asking myself the question, what can we learn from history? And do we see situations in which we had state money and private money? And my answer is very clear to that extent. Yes, history shows us that in the money sector, we have a more or less permanent going back and forth from state money or public money to private money, and from private money to public money. In the very old ages, we mainly had private money. Later, we had then more public money. And this is what I would like to discuss a little bit in more detail during the next 10 or 11 minutes. Very obviously, I cannot touch upon all issues which could be addressed in this context. In particular, I'm not going into the details of the fact that we have seen a movement of the traditional financial system being account-based to a token-based system, because as far as CBDCs and stablecoins are concerned, both regimes are token-based. But I would like to raise a general question looking at money. Shouldn't the same business activity lead to the same, or at least to a comparable legal regime? A certain part of my presentation has already been discussed by the keynote presentation of Iris, and this allows me to be shorter on some specific issues as far as the definition of stablecoins is concerned. And in particular, I would like to take up the very last response of Iris to the question of Filippo and look at the competitive environment between public and private currencies. If I look at a relatively old ECB paper, then I can see that ECB distinguished 4 different categories of stablecoins, namely tokenized funds, off-chain collateralized stablecoins, on-chain collateralized stablecoins, and algorithmic stablecoins, being not really backed by stable underlyings, but by pure expectations and the outcome we have seen with the Terra Luna events. I'm concentrating in my subsequent thoughts on fiat currency-backed stablecoins, in particular the most important one which we see in practice, namely Tether and USDC managed by Circle. Just a final introductory remark. If we look at the CBDC discussion, we quite often see the distinction between wholesale and retail, and very obviously, if I look at stablecoins, I would mainly like to address the retail side. I show this slide because political perceptions are different. The ECB and the European Union is going towards wholesale and retail CBDC, whereas, for example, the Swiss Central Bank only concentrates on wholesale CBDC and does not consider, at least for the time being, to issue retail CBDCs. And this leads me now to the first core challenges which I would like to quickly address and also relate somehow to the political dimensions of the respective challenges. Somehow very obviously, we are aware of the fact that global stablecoins could potentially become systematically important, and this might be a reason for regulation. And we also do have the challenges for effective regulation supervision because of the structure of the crypto markets and the information as asymmetries linked to crypto markets. However, the question is, of course, to what extent should the challenges be regulated in detail? And if I look at the already mentioned FSB high-level recommendations for the regulation, supervision, and oversight of stablecoin arrangements from 2023, and I think here I'm in line with Iris, I have the impression that the FSB approach leads or would lead to an accelerated regulation of stable coins. And knowing that we do have representatives of central banks here in the room and maybe also online participating once in a while, I like to make a provocative statement. FSB is, of course, controlled or dominated by central banks and governmental regulations, and international standard setters therefore emphasize or put much emphasis on potential risks, because the innovative potential of these technological developments enable competition in areas that were previously reserved for them. And quite often people do not like to have too much competition. I'm not only making a provocative remark to the side of international standard setters and central banks. I would also like to make, so to speak, on the backside of the medal, a critical remark as far as commercial banks are concerned. The idea to issue retail CBDCs has generated concerns among banks and especially payment services providers, which are in fear of losing substantial transaction fees and balance sheets backing following deposit withdrawals. Consequently, this would cause a disintermediation of existing bank models. I don't think that it's too dramatic because CBDC holdings do not earn any interest or other financial incentives, but nevertheless, at least the big commercial banks have not been very much in favor of stablecoins and of competition in this field. Notwithstanding the fact that stable coins indeed would promise benefits such as efficiency, transparency, and partly also security for private consumers. And in addition, coming back to my introductory remark of having private and public money from different angles. We have also seen most recently in the year 2025, since the new US administration took office, that the new US policy supports dollar-backed stablecoins and oppose CBDC, while the EU takes the opposite stance, arguing that CBDC, including a potential digital euro, provide financial stability, whereas stablecoins could create financial stability risk. What is the message? Politics very much impact the aspect of having rather public money or rather private money. I'm not going into the details of the different national regulations. First of all, since we have Dirk Zetsche next to me giving much more thorough introduction into the MiCAR regulations, I can only say recital of MiCAR says CBDCs are not covered. Stablecoins are, of course, covered, but the recital is perhaps partly limited by the provision regulating central banks, but I leave this to Dirk. Next country which is mentioned here, Switzerland, not only because it's my home country, but the first and most important stablecoin project at the beginning, namely Libre Diem, already mentioned by Rosa, was launched in Switzerland, and at that time Switzerland was of the opinion that the regulatory regime should be something like a payment infrastructure regulation. In the meantime, if we look at UK, United Arab Emirates and Singapore, we see that regulations are usually introduced into payment services regulations, for example, in the United Kingdom in 2023, in the United Arab Emirates in 2024, and in Singapore 2019. So stablecoins apparently are an expression of a payment services regime, and we usually have two major regulatory issues to be dealt with. First of all, reserves must be available so that the consumer can convert the stablecoin, and secondly, stablecoins must be held in separate accounts. And this leads me to my last slide. Personally, I think we need a stringent regulatory classification. It is not adequate to treat stable coins, whatever the underlyings are, being fiat currency or algorithms, in the same way. And in fact, we also need to follow the technology neutrality approach. I think this is generally accepted. Since stablecoins are money, at least functionally money, we need the implementation of technically appropriate AML provisions. In other words, we have to see that we avoid arbitrage just because we move from public to private money or from private to public money. I'm not going into the details because I think the key is here not really the legal provision, which forbids AML and finance terrorism. The key is really the implementation of technical compliance measures, such as zero knowledge proof and similar procedures. Eventually can come back in the discussion to that. Compliance with fundamental regulatory needs means that the holder of a stablecoin must have an unconditional right to a repayment, so reserves need to be ensured and liquidity as well. The amount paid for a stablecoin could be secured by separated funds, by provided for a resilient corresponding default guarantee, partly foreseen in MiCAR. And secondly, another important regulatory issue is the segregation or separation of customer assets in the event of financial difficulties of the providers of stable coin.
And I will have to ask you to finalize.
Yeah, I'm at the very last point.
They will complain that I interrupted them, yeah? The previous.
Yeah.
Thank you.
My very last point is the question of legal tender. Here, it is becoming difficult. I have learned from, frankly, at the very beginning, legal tender is a specific term. And my question, my provocative question would be, shouldn't we redefine money in a broader way and say everything which has functionally monetary value is money, but redefine not the money, but legal tender in a more narrow way? Thank you very much.
Thank you very much. Let's go back to F.A. Mann later. What is the definition of legal tender? Dirk, you are going to speak on a topic, the MiCAR, on which you have recently published a great commentary. Is that correct? I have not read it yet. They told me it's good.
How can I answer that question without being either impolite or pompous? So thank you very much for the praise. Let's hope that others have a judgment on the book. What we try to link in our roundtable is insights from Rolf with insights on myself on MiCAR, and the chairman posed an apparently simple question to me. Dirk, why don't you just discuss how MiCAR regulates CBDCs or doesn't regulate CBDCs? And of course, in order to understand MiCAR, we need to know that it's part of a major overhaul of the digital financial technology approaches, and in this regard it comes with quite some product regulation, but also a lot of intermediary regulation, and I will get back to that. And in order to understand what MiCAR is filling a gap. The problem with that approach is that we don't know where this gap starts and the gap ends, because terms like financial instruments or also certain deposit-based structures are simply uncertain, and so now MiCAR is filling whatever is not filled by something else, and we will probably figure out in the future what it's doing. The most important part to understanding MiCAR is that we have one part which applies to so-called crypto intermediaries. We call them crypto asset service providers, and there are several parts on product regulation, including e-money tokens and tokens referring to basket of assets. We call them RAT, asset reference tokens, and everything else which we don't cover by other ways may be called other crypto assets. The terminology is not really clear because there are other crypto assets which are not covered by MiCAR, yet they are not called other crypto assets? So the terminology is quite confusing, and I guess in this regard, the important part is that these CASP rules address the microprudential oversight on crypto asset service providers, in particular crypto custody, and I will get back to that. When you look at all these definitions, you can get some problems with your eyes. The main part which we'll address in the bottom is that of crypto asset service providers, that they provide certain services in relation to crypto assets, and that has a meaning for the rest. Now, let's talk about CBDCs in the context of MiCA. MiCA has basically two provisions that deal with that. On the one hand, we have recitals, and these recitals are quite broad by exempting all digital assets issued by central banks when they act in a monetary authority capacity. All central banks acting in a monetary authority capacity. Important is the difference to the binding text. In the binding text, you have a reference only to EU and member state central banks, which poses, of course, practical questions. First of all, what is the acting in their capacity as monetary authorities if the EU member states have lost that function to the ECB? Yeah, so there's probably that exemption doesn't apply. But the other thing is, and that is more important, what happens, for instance, when the central bank acts as custodian institution. So we have account-based and we have token-based ones. And on an account, you could rather easily say the account is basically something that previously was done in the first-tier intermediary system in central bank money, so there's probably no difference. And now we have, of course, a problem that tokens may be held in custody. And that's a new function. And I think that understanding that monetary authority capacity in the future will imply also custody over central bank issued tokens. Yeah, so whether you store whatever the coins, the real world coins, or whether you store the tokens cannot make a substantive difference. It's not explicitly said, but I think this is a modern interpretation of monetary capacity in the centralized world. Where I'm not so 100% certain about the answer is what happens with central bank digital currencies issued by third countries. So the renminbi, for instance, let's assume that we have an EU person sitting in the EU holding the renminbi, the digital yuan. Now we have several ways of dealing with that. We could say this is not a service in the union, but that would lead to discrepancy when you compare it to stable coins marketed to EU citizens, and they would be in the union. Then we can say CBDCs don't qualify as any specific type of asset under MiCA. Yet the interesting part is that MiCA applies, at least Title V on crypto intermediaries, also applies to type of crypto assets that are not covered by Title 2 to 4 MiCA. So for instance, Bitcoin is not covered by 2 to 4, but it's covered by Title V. So here in this regard, it would also be not 100% convincing. And then the last one is simply saying a CBDC is not a crypto asset under MiCA, simply relying on the recital. But I mentioned that the binding text is not so 100% identical with the recital. And we know that the binding text is binding because it's binding. So then another question that comes up, so I leave the answer open and I will give you the answer a little bit later. So then we can think about simple CASPs, also crypto asset service providers holding clients' CBDCs. Are they in or out? This is a different question from the issuer capacity. And here, when we just look at the literal wording, we see that the crypto asset definition is wide and would potentially also cover rights established by central banks. So I think that a CASP holding a Chinese renminbi would probably be in scope of Title V MiCA. It's not 100% clear because the alternative would be that we have a specialized regime. But I'm thinking we know that Title V is wider than Title 2 to 4. So I'm thinking here we can reasonably assume that crypto custodians holding the digital yuan is in MiCA. Well, the question is, why don't we have a statement on CBDCs in the binding text, correct? So why is it left unclear? And here I have a number of ideas. On the one hand, MiCA is a response to certain scandals in the crypto industry, in particular ICO fraud, instability with stablecoins, and Libra is global custodian, the global stablecoin system. And so CBDCs were simply out of scope by then. Yeah? So MiCA is in the mindset of 2020, 21. Then when you think of what a CBDC is, it's usually insolvency protected because of the endless balance sheet of the central bank. So you could say there is not the insolvency problem. And that means the central banks have an interest in taking care of their own interest. And so MiCA shouldn't apply for that reason. Then, of course, the digital euro is somehow developed in parallel. So we believe probably that MiCA doesn't want to interfere with that. So it shall leave enough space to for developing the digital euro. And then maybe the main reason is that very few CBDCs are actually truly functioning right now. Most of them are projects. And so if you would govern something that with MiCA that doesn't have a scope, it's also a little bit superfluous. We can do that later when we apply the acts on the digital euro to kind of rectify the solution. So definitely CBDCs were out of the regulator, but now, of course, following up with the tradition of this roundtable to leave some questions, the metaphysical question is the regulation of CBDC in this context a matter of crypto law, or is it a matter of monetary law? Yeah, because I'm thinking this is really the main question. And when I answer now, it's probably a little bit of both. Then this is sound weird, but probably the crypto intermediaries that hold the tokens are better regulated as crypto intermediaries as CAS, because we have better reflecting ICT risk provisions and custody risk provisions. Although payments law also seems to function, and here an interesting note, in 2014, the first regulator in the world who regulated cryptocurrencies was the Luxembourg CSSF, issuing a release to treat payments law on Bitcoin. And why that? Because it came with money laundering provisions, and it came with clear allocation of transfer and storage provisions, because payments law was existing back then. So they analogized Bitcoin to payments law. And of course, CBDC is even a much stronger case for payments law than in the world of Bitcoin. So there is, of course, one way to deal it on monetary law, and probably those jurisdictions who don't have MiCA are very much tempted to use just payments law by way of analogy to CBDCs, and then they're done. That's one solution. Why can't we leave it unregulated? Rolf said it, money laundering concerns, but also transaction certainty concerns prevent us from doing nothing. Otherwise, I would say doing nothing is always a good option. Thank you.
Thank you very much, Dirk. Another way to state whether it's a metaphysical question is if you have a given curriculum in a program, yeah, where you teach monetary law, capital markets law, and payments law, yeah, in which of these courses would you teach the MiCA and the digital euro regulation, yeah? It's the flip side of that.
That is a very good question. We have in our banking and financial law master in Luxembourg, we have a fintech lecture. And in fact, the main problem in the 24 hours is that we cannot cover the full basics of payments law in addition to investment law, in addition to crypto law. And when you don't have the full overview, the students will be lost.
Last but not least.
Yeah, thanks so much for having me on the panel. Thank you so much to the organizers. I'm amazed in being in this historic room and building. And Dirk, if your students need more payments or payment law, they can come to Marburg to my fintech lecture, because I'm doing a lot of payments in my fintech lecture. we can meet somewhere in the middle. So no, back to the topic of my little presentation. It's about competition, and it's about a kind of alternative maybe or competitive concept. Well, next to or alongside CBDC. And this is a concept that is, well, actually probably a mainly German one. It was developed by the German banking industry, the Deutsche Kreditwirtschaft, and the Federation of German Industries, the Bundesverband der deutschen Industrie, in a joint concept for introducing commercial bank money tokens. So CBMTs, not CBDCs. And these tokens are designed to combine the legal certainty and stability of traditional commercial bank money with the technological advantages of blockchain technology, also the crypto world that we've been talking about during the afternoon. What was my mistake? I have to press here. It's on. Maybe I'm too stupid. That's the most likely version. Oh yeah, now it's working. Okay, thank you so much. Maybe I need assistance all over. Thank you, Dirk, for taking the job. We are currently seeking major changes in how money and value are transferred. Technologies like DLTs, automated supply chains, smart contracts are reshaping the financial world. At the same time, our existing payment systems are reaching their limits. They are not built for real-time, programmable and fully digital processes, as we have seen also during the afternoon. So this concept of commercial bank money tokens, CBMT, is at least intended to be a response to these challenges. It was developed to meet the needs of the industrial sector, not only the German one, but also the German one. So CBMT links, or is intended to link the safety of traditional bank deposits with the flexibility of blockchain technology. And this proof of concept that you can see on the slide, at least the first page of it, was launched in summer of 2024. That's the last version, and major German banks like the Deutsche Bank, Commerzbank, DZ Bank, but also BASF, Siemens and Mercedes-Benz have been participants. They tested various use cases. These ranged from simple interbank payments to complex applications such as automated working capital management and real-time micropayments. Great. So let's have a look at a broader look at the current money landscape, at least from the perspective of, in this case, Deutsche Bank, where I have copied from this slide. So we see on the one side the private sector, and on the other side the public sector. So when it comes to the traditional public version of money, we have cash, of course, notes and coins, and we have central bank reserves, which we as retail customers have no access to. So we use cash in the retail sector, and the wholesale version, that's central bank reserves. On the other side, we have private money issued by commercial banks as book money, deposits, and we have, and I mean, from my perspective, from a legal perspective, electronic money, but that's just another kind of commercial bank money with a separate kind of regulation, because it just happened to be in a different secondary legal act, the e-money directive. But I mean, from a conceptual perspective, it's also book money or commercial bank money, just with some differences, slight differences in some details here and there. And if you just take this status quo and put it forward to a crypto or more digital world, you see on the public side of money, the retail CBDC and the wholesale CBDC. But when it comes to private money, we still have we're lacking a solution, at least until this proof of concept. And the solution here might be that we have on the electronic money side, the e-money tokens under MiCA, but we also might have a tokenized version of the existing deposits, of the existing scriptural money or book money that we already know and we probably all use in our checking accounts. That's at least the vision of the German banking industry. And what you can't see here on the slide is cryptocurrencies like Bitcoin, Ethereum, and others. And under the definition, at least, of the German banking industry, who was in charge of this proof of concept, this is not money. From the perspective of monetary law, I would agree. Always in lectures, I always ask the testing question, saying, I mean, get out of the room, try to buy a coffee. If you can buy the coffee and using Bitcoins, then it's money. And before we don't reach this stadium, it's probably not. We can discuss this later, maybe later, but that's at least my approach. And therefore, I can, in this respect, understand the proof of concept here. So I just try to, no, the wrong direction. Oh yeah, cool, yeah, it's working. So the idea behind this CBMT concept is somewhat simple, at least the basic point or the starting point. It's to allow companies to use commercial bank money in a new way, in a more digital way, in a crypto way. So the idea, the basic idea is just developing the existing book money in a 2.0 or 4.0 version. So using the same legal framework as we already know it for book money, and just having a new technological infrastructure underneath, but still the same legal framework. So you have book money updated in an updated version. So what are the features in this proof of concept here? Well, you have 24/7 real-time payments. Okay, that's not so new. Also, under PSD2 and the SEPA regulation, you have already 24/7 real-time payments, but nevertheless, these payments can also be programmed. And that's new because you can use smart contracts and others to have so-called conditional transfers. Then you can use, and that's another aspect here, it's not for the broader retail market for all private customers. It's designed for enterprises and professional users who can also use their internal DLT infrastructure for transferring these CBMTs for internal transactions, payments within the company structure, or also with some partners within their production framework. So also comparing to CBDC, at least the digital euro as we discussed the concept now, the CBMT would function as an unlimited store of value. So there's no 3,000 euro limit or whatever. So your checking account can never be too full. So there's no waterfall or whatever where the money goes to the next checking account. No, so there's always place and storage for more money. So conversion is intended to be always guaranteed. So you can always get the regular traditional book money back if you give the CBMT units back to the banks within the system. Maybe to have an overview on some legal challenges here, but just very, very briefly. The main objective, as I've already mentioned from a legal perspective, is that CBMT should be a deposit under EU secondary law, but also under German law, for example, German Banking Supervision Law, the KWG, and not e-money. It should be crypto book money, so a new version of book money within the existing legal framework. So no MiCA, no MiFID II, and no e-money directive and those parts of the PSD2 that also would apply to e-money. How can you get there? Well, just to give you a very quick overview on for the deposits questions, or the questions arising out of the deposit definition, the main question here is whether we have an unconditionally repayable claim. Because usually if you have just scriptural money or book money, I mean, how can you redeem the book money when you go to your bank who's in charge of your checking account? I mean, you just say, okay, give me cash. That's it. You don't need anything that you need in exchange for getting back the cash. But here you have to redeem the tokens. So you need the tokens in order to get, for example, cash or the traditional book money. So is it really unconditional? Because that's the condition in order to get the book money back. But from my perspective, it's just, I mean, it's just a reverse transaction compared to the original change of book money for CBMT, and here it's just a way back. So it's not a real condition, at least in a legal sense. So this would, from my perspective, and also from other legal scholars, in Germany at least, not be a hurdle for the definition or the characterization as a deposit. As a result, we are within the Deposit Guarantee Scheme Directive, so we have some protection, and we are outside of the scope of MiCA due to Article 2 MiCA. We don't have e-money tokens as well. E-money is also a question, and here we have...
We only have 2 minutes?
2 minutes? Yeah, I'll make it. Thank you so much. Thank you. We have, when it comes to e-money, we have two problems, or maybe 2 ways out, 2 doors that you can use as an exit. It's acceptance by third parties, and it's the limited network exemption. My personal preference goes to the limited network exemption in the light of a decision of the French Conseil d'État in interpreting the French provisions under the e-money directive too. So from my perspective, we don't have e-money because of the limited network exemption here. I have some slides comparing CBMT and CBDC, but I just want to use it in case of some questions concerning these perspectives. And therefore, I want to sum up in a nutshell. My perspective here, summarizing, is that we have at least the chance of complementarity instead of competition. So we need a private sector answer to the needs of the society, of the economy. So we have the private answer, for example, in a CBMT concept, and the CBDC concept as the public money answer. We see here on the other side the CBDC as an evolution of cash, at least if we follow the tokenized instead of a account-based approach. And on the other side, we see CBMT, or might see CBMT, as the evolution, the parallel evolution of book money in a Web3 or crypto or smart contract world. And finally, all legal assumptions that I've made during my short presentation definitely depend on the concrete details of the product design of CBMT, which are still in discussion. Thank you so much for listening. I'm very much looking forward to questions.
Excellent. Thank you all so much. I think we are still left with some 20 to 25 minutes for a discussion. And I would like to address myself to yourselves. Can we have our panelists who are online, because they may wish also to intervene, or some questions could be addressed. Rolf, do you have any question to the other speakers?
Yeah, I do have a very short question to Sebastian. I very much liked your approach and the way how you described the possibility somehow to enlarge exchange of monetary values. I was just a little bit puzzled why you said at the very end, this is complementarity instead of competition. I like competition, and I would also see a possibility that these could be competitive tools, which you have described.
Yeah, you're totally right. I mean, it is a competition. I was just trying to be a little bit more polite to the CBDC world, and it's just a question of politeness, but the truth is probably it's competition. And maybe complementarity is the result, and competition is the beginning.
Thank you.
Thank you so much. You're totally right.
Thank you very much. Dirk?
Yeah, I want to ask a question to Caroline. I wonder, when you present these issues in private international law, and I have come across some of them, what this means for the efficiency of the new tokenized payment system. The Hague Convention will probably take another decade until then every member state has implemented the recommendation of the experts and so on. My question is, wouldn't that for years impair enormous uncertainty to any transaction? And is that affordable in the world of, let's say, payments or close to payment equivalents, given that these payments are extremely sensitive to uncertainties because of the very low margin that you usually earn with them. And so what you present there is, in fact, it's extremely insightful. Yeah? So they're facing all the problems, yeah? Which law applies basically in all dimensions. And that means cross-border transaction will be impaired for centuries, yeah, if I see this correctly.
Thank you. Can you hear me?
Yes.
Okay. Thank you. Well, that's thank you for your question. First, I think that it's a good thing that the Hague Conference is tackling the issue. Of course, we know that the work at these institutions sometimes can take some time, but the first production will not necessarily be a convention, but something else, which could be a bit quicker to be adopted if it's not a hard law instrument. I hear a lot of echo. Do you also hear a lot of echo?
We have no problem. We hear you very well.
Okay. The uncertainty that exists right now indeed cannot be written off very soon. But I would like to emphasize that if still today we haven't any common conflict of law rules, and still the payment system, even the cross-border payments, they are correctly made usually, and even though we do not have a universal convention on conflict of law rules, it still works today. So for CBDC, I think we have some time because for the time being, it's mostly projects, as you mentioned, and not. There are very few, indeed, CBDC which have been adopted right now. So we have some time to come up with some ideas and rules, and maybe not in the traditional way, having a convention, but maybe other kind of instruments that could speed up a little bit the process and help legislators, central banks to have a common idea of what they should implement in their legislation so as to avoid, or to treat well, to resolve well the conflict of law problems.
Okay. Thank you so much. I will revert then with a Lex Moneta, yeah, but let me first ask Rosa if you would have any question to anyone.
Yeah, I have. I wanted to go back to the question that was actually put to Lex Moneta. So the presentation, Caroline, and I like that you elaborate on the flower, the money flower, and you put in the money flower, which we have seen and discussed before the legal applicable law. It is true that the Lex Moneta, of course, in the context of international money, is problematic. I would like, just to join the question that was already put in the chat, your thoughts about that and how will that affect your money flower?
Okay, so should I try to answer? So that's also in the, so I can answer both to Christos and your question. Yeah, but my feeling, and of course, this is something that should be more studied because, again, still CBDCs are not finished yet. We still need to see how exactly they will be adopted, their technicalities, etc. But the image of the galaxy of the flower is to, in 10 minutes or 12, because maybe I took too much time, but is to show that with the adoption of CBDCs, I think that something that will come with it is the expansive scope of application of the Lex Monetae. There are some questions that so far were not governed by the Lex Monetae, but there will be, I think, unmistakably by the Lex Monetae because of the technology. The central banks will have the possibility to decide some of the issues that so far could not be decided by them because it was just It was just cash, banknotes, etc. So that, and I think that we need to think about that, to think about this expanding scope of the Lex Monetae, because it will have some consequences about that. And to answer to Christo's question, what is the Lex Monetae? When the currency is issued by a group of states, like it is, of course, for the euro. In the CBDC's area, the Lex Monetae will be EU law. It will not be any member state national law. And what I'm thinking since the very beginning of the issuance, the creation of the euro, is that EU law on currency is not complete. It has not been finished. So this is a default, an inconvenience of EU law. So there are some areas that should be tackled by EU law, and they are not, and so they are still in the hands, on the shoulder of member states. And so that is something that should be solved when we will adopt the CBDC, because in my opinion, Lex Monetae here means only EU law, and it doesn't mean German law because the ECB is in Frankfurt, or whatever member states law. So this is still a in construction project, and EU law should be well achieved. I mean, should be finished and not left unfinished as it was when the euro was adopted.
Have a topic for next conference, yeah? But not today. Thank you very much. If you allow me, I have some questions, a bunch of questions on Ruth.
Okay, I also have a question to Rolf, so later.
Now, because I think we're all very much interested in...
May I just add one sentence? I think your questions were, of course, fully on the point, but we do have many cryptocurrencies which do not lead back to an issuer. So Lex Monetae will completely disappear.
Okay, for the next conference, yeah? You have a guaranteed place on the panel, yeah? So, Ruth, I want to hear your presentation again and again, because it raises a lot of issues, yeah? I mean, I heard that people have a distrust in commercial banks, yeah? But the digital shekel would be issued by the Central Bank of Israel. So do people understand this difference when they were asked about how does it come? And a second point, that two other points which were, at least for me, very interesting, is that it was accepted, or would be accepted, more by people who are more aged. How come?
Yes.
This is very interesting. And the third point, you said that you made reference to the literacy level, yeah? Did you check here also the digital literacy? Because this is closer, yeah? We had a very recent research by the Banca d'Italia on digital research last year or the year before, yeah? So
yes.
These are some mixed feelings of misunderstanding from someone who heard this for the first time.
Okay, well, this was a very short presentation, and of course, the Bank of Israel published on its website the very long and detailed research conclusions, so everybody is invited to read it. Well, as to your first question, did people understand the difference between bank money and CBDC? My answer is yes. This was part of the pilot, and this is why we held a separate pilot before starting our actual survey, and we checked, and people did understand that the CBDC is backed by the Bank of Israel. As to the issue of age, this is a very important point. And
how would the distrust come about? How is the distrust to the banking system linked here?
We found that people had high level of trust, both in the central bank and commercial banks. They didn't express distrust in commercial banks. So
Maybe I
maybe I wasn't
misunderstood.
clear about it.
Okay.
Yes. Okay. I can.
Go on.
I can later show again
No,
the
no, we don't
slide.
have time, unfortunately.
Okay. Okay. And about literacy, we checked both financial literacy and digital financial literacy. We used the OECD 2022 index and toolkit, and this was the first questionnaire. And we saw that the higher the level of literacy, the higher the level of interest in the CBDC. But about age, you are correct, because in Israel, this was a bit strange. A few other countries conducted similar surveys, and they found that younger people showed more interest in adopting a CBDC. In Israel, this result was a bit unusual because elder people, especially the age group of 40 plus, 50 plus, 60 plus, were more interested in using the CBDC.
Thank you so much. Franklin, you have been listening to so many lawyers here, yeah? Prominent law professors and excellent scholars. You understand what when you said that money or legal tender is a declaration by the state, what we understand as lawyers is that it's an obligation set by law. Do you have any question, any specific question to any of the other members of the panel? Or any comment that you would like to make?
Well, one comment I can make is I think everybody seems to be on the same page in talking about money is a contested technology. You know, it's central bank versus private bank. It's one kind of law versus another law. Public versus private. It's a political matter. It's technology and sovereignty. It's a constant battle, a constant interaction that moves this thing forward. But I had a question for Rolf. At the very end of his talk, he was saying that maybe legal tender has to be redefined in a more narrow way. I'd like to hear what that's about.
Well, I was afraid that you would raise this question. Indeed, it's also something for the next conference. My point was, let's allow more competition in the monetary field, and let's evolve private schemes as described by Sebastian, but also as developed in the stablecoin field. And if we do have some regulatory restrictions as far as reserves, liquidity, segregation is concerned, I think private money would fulfill, at least functionally, the same role as state money for the time being. However, the direct question, is stablecoin money, is of course tied to the question of legal tender. And stablecoins most likely would not qualify for the FA-MAN definition of legal tender. And then I was just raising the question, shouldn't we redefine legal tender in a little bit narrower way? We have the question, does somebody or is somebody obliged to accept a certain currency? This is an aspect of legal tender, and here I would argue, well, I cannot really imagine that we require from everybody, also from the older generation, to accept stablecoins, because the older generation is not able to have a wallet, etc. Insofar, I think we need to keep a certain core, but at least we should raise the question and discuss possibilities to define or to exclude certain characteristics from the traditional definition of legal tender. But I guess the question of legal tender is also coming up tomorrow in connection with CBDC. We do have similar questions. Does, for example, everybody has to accept CBDC as legal tender? Probably also not.
Correct. We'll speak more about that tomorrow. We have this panel. Any further questions? Sebastian? Maybe I give Sebastian the floor because he didn't have a second round, and then to you, Ruth, and then Dirk.
Okay.
Okay, thank you so much. I have a question that goes to Israel probably especially, but it's probably an open question to all here on the panel who's willing and able to answer. It's about acceptance. And starting with a short story, I'm just coming back from a longer 2.5 week stay in China. And one of the objectives was to try out the Chinese CBDC. So I downloaded the official e-yuan app to my iPhone and tried to use it in China. I asked many colleagues and friends, Chinese colleagues and friends, okay, whether they ever used it and how it's working. So I was neither able to connect my Chinese checking account nor my German credit cards to the account, so I failed in using, but I met nobody during the 2.5 weeks in several cities and 6 universities who ever used the Chinese CBDC even once. So the Chinese government is now trying to, let's say, force a little bit people using that in paying some state public employees with the e-yuan, and also forcing some private companies doing the same. That's a measure that probably we in the EU would not...
The question, please.
The question is, seeing this problem, how can we improve acceptance of CBDC in a free society as we live in?
So we have studies in financial inclusion, how we can implement and achieve use of all type of payment technology, usually government-induced payments and government-induced services, a first step. Then you usually assign some fringe benefits to the use of that, so a little bit higher interest rate or something. And as soon as these public use cases have spread, the private use cases come around. And so there is studies in the financial inclusion field, in particular from developing countries, how to get there. So we are happy to provide you these papers.
Any further reactions?
And I may add, yes, I may add that surveys like the one we did in Israel is also important, because it is important to assess and evaluate what specific features of a potential CBDC may be more important for the public. So this is another way how to try to increase the willingness or adoption of the CBDC.
Okay.
Yes. Now I have a question, if I may, Christos? Yes. Can you hear me?
Yes, of course.
Okay. Yes. My question is to Rolf, but other speakers may wish to answer as well, and it is in light of the latest geopolitical tensions. How do you see the role of CBDCs evolving in relation to stablecoins? Are they likely to complement or compete with each other in the long term, especially in light of the current geopolitical tensions and the push for greater monetary sovereignty by nation states? And I can give an example, the last executive order of President Trump that actually eliminated the digital dollar in the United States.
Thank you very much for the question. As I've mentioned, indeed, politics changed in the United States with the Trump administration, and CBDCs are not anymore a monetary objective or tool for US politics, and the Trump administration very much puts emphasis now on US dollar-backed stable coins. And I also made this remark because I have the impression that politics very much influence the monetary order. On the other hand, we see, for example, China. I have not been in China lately, and I didn't download any app, but China is really trying to use yuan CBDC along supply chains with friendly countries, Silk Road, but also African countries, and they try to push the digital yuan or renminbi as a matter of exerting more political influence also on less developed countries. Insofar, I think we cannot say public money or private money will succeed. It depends upon the political interest in this field.
So I think the time is coming close to the end. I would like you all to make a final comment for 1 minute or so, but please, those of you who wish, I'd like to have an answer to a question. We take as an assumption that central banks don't go bankrupt, yeah? And we say that the central bank digital currencies are safer than the stable coins, whatever, because the issuer cannot fail. Is that correct? Can central banks go bankrupt? I have heard that the central bank in the Philippines and in Zimbabwe went bankrupt. So, along with your final comment, you may wish to take a position on that. Let me start here. Dirk, what do you think?
Well,
and please conclude.
Of course, I would even go further and say also several EU central banks can go bankrupt, and here's why. The theoretical assumptions that they are insolvency-proof stems from a dual assumption. The first is unlimited access to credit because of unlimited ability to print money. And we all know that all central banks in the Eurozone don't have the ability to print money anymore. Exactly. So the second assumption is missing. So in turn, for instance, in a situation where the trust in the central bank is undermined because of a state crisis, political crisis, of course, the central bank can go bankrupt. Of course, when we think of who will issue CBDCs in Europe, that will be the ECB, and the ECB has the right to print money. The cases of Philippines, if I'm correct, was they started printing money, but the Filipinos opted out of the Filipino currency into the US dollar, and that way no one wanted the money anymore that was printed, hyperinflation, and then it stopped printing money, and that means their monetary supply was over. So this is a traditional problem when the trust in the respective bank is undercut by drastic measures, yeah. But usually it's external shocks that support that, not so much internal shocks.
Thank you so much. By the way, I fully agree.
I would like to give a short, indirect answer because Dirk has really outlined the problem very sufficiently. We do not only have the problem of the solvency of a central bank, but as apparently the inquiries in Israel have shown, we also do have the problem of cyber attacks. And even if a central bank would remain solvent, we do not know whether CBDC is not going to completely disappear in case of a severe cyber hack. And then somehow the owner of the CBDC has also lost the monetary value.
Thank you so much.
Well, concluding, I think we need generally more innovation, more courage, and more sovereignty in the EU when it comes to payments and money. And that's a reaction also to global realities. But that does also lead to competition within the private and public sector. So more innovation, more sovereignty based on a competition between private and public solutions.
Thank you. Elizabeth, would it be the Lex concursus who should apply in this case?
You mean
Caroline? I'm sorry. I mixed it, sorry. Caroline.
Yeah, might be, but the Lex concursus, as you know, for banking sector is particular, and for central banks, there's no specific legislation dealing with the insolvency of a central bank. So if in theory, maybe that would be possible, in practice, there would be probably some state intervention that would try to avoid that. So I think here there's a difference between what would be possible in theory and in practice.
Rosa?
Please. Can you hear me? Central banks can go bankrupt. In the most pertinent issue these days is the losses that central banks are experiencing with quantitative tightening and the allocation sometimes of those losses. But I don't disagree with anything that has been said so far. My final comment, I wanted to say something since tomorrow is going to be discussed again, but I will not be participating in one of the tables, though yes, as a participant, and is that the concept of legal tender is also evolving. And indeed, in the UK and under common law jurisdictions, is not considered as important as, for instance, we consider it under EU law and in general in civil law jurisdictions. And I have had very interesting discussions in this regard with my colleague Simon Gleeson and also with Charles Goodhart, both from a legal and economic perspective. So I think it's important to look at legal tender as an evolving concept. And the final thing goes to Caroline about EU law. The ECB remains a fascinating legal creature because it's the only central bank in the world that is not backed by a state. It's a central bank without a state. And therefore, lex moneta and just generally a lot of issues that have to deal with sovereignty are complicated because ultimately the repositories or the member states that have agreed to transfer the sovereignty, partial transfer of sovereignty to the ECB. So I have consumed my 1 minute, but perhaps raised more questions than answers. But this is because this is the situation of the ECB, a central bank without a state.
Thank you very much twice, also for answering this question, because I tend to agree with you on this issue of the lex monetae. But we have another conference for that, yeah? I promised another day, yeah? Ruth, would you like to have a final comment? And then we go to Franklin, who should not answer on the question whether central banks go bankrupt, yeah? For obvious reasons.
Yeah. We discussed earlier how can we increase the level of adoption. So one way would be by earning interest and promising interest to participants. So just to make another point, in the Israeli research, we checked the interest rate of 3.5%. And of course, this today, it is a very high interest. People were very much interested in withdrawing their money from banks and investing or depositing it in the digital shekel account. However, this raises other question, of course, of disintermediation and how do we balance between the safety and security of central banks and, of course, the banking system.
Okay, it's a pity that you will not be tomorrow.
Yeah, I know.
You may wish, because it's exactly the topic that I will develop tomorrow, yeah, in relation to the digital euro, and whether the risk of this disintermediation is so high, yeah, and how it can be resolved, because there are several ways that you can overcome it. But this is for tomorrow. Franklin, yourselves.
Well, I can say, as regards the central bank, before there was a central bank, when the US Treasury did its own business, the only time it got in trouble was in the early 19th century, when basically people could either not get a hold of its money, its legal tender, or they had a better alternative to that money. So competition can be a real problem. Overall, what the roundtable has told me, and I think it's an idea I really adhere to, is money is constantly evolving. It's a constant discussion. Different ideas will come along, different technology will come along, and basically all of society has to figure out what this new money is and what we're going to do with it. And that's end of my comments.
Thank you so much. I wish this panel would not end, but is there any? No, I think all have had the opportunity. Thank you so much, all of you. I think they deserve all a great applause here again. Yeah. And we have food for thought for tomorrow, yeah? To be continued. Yeah. Thank you.
Thank you so much for all the speakers. Remotely connected from Florence. Thank you so much to all of you. Thank you. I hope to see you very soon in Florence for a new opportunity to have a conference here with you. Thank you so much. We have here for people in presence, we have 30 minutes, no more, because we have a problem with the closing of the Rector building. So we have 30 minutes in the same garden. We have a refreshment before greetings and going to dinner. Thank you so much.